Yeah.
So yeah, the use case is Spotify.
Sort of Spotify, Bernard, is that why you like us?
What's that?
Sort of Spotify?
Yeah.
What?
Like you short of Spotify, is that why you
I
like us?
didn't know.
Santa Barbara?
It's National Donut Coffee Day, I think, or something.
Oh, really?
I was thinking about the Alice Group. It's 300 seat.
That's fine.
That can join together, and you can go inside, and you can see
Come on, man.
visualization of the world's most complex problem that supercomputers can solve.
That's definitely amazing stuff. Is it time yet? I know I'm like featuring the CFA up here. Don't mean to advertise, but I met him yesterday. Let's see. Oh, hey Jim. Nice to see you, man. Nice to meet you, actually.
Good morning. Nice to meet you. Hey, how are you?
Yeah, doing good.
How do you pronounce your full name for me, please?
Kay, last name is Quinn, best known as the Enterprise Guy.
Understood. Thank you.
You're welcome. Yeah, so it's 10 o'clock, huh? We'll get started when maybe a little bit more people come in. What a week, man. What a week for silver. Like, it got me really excited, and then, you know, it...
I can keep track of silver. What happened?
Well, I mean, it's just the metals in general. They kind of spiked up in the week and then faded off at the end of the week. So now it's maybe it looks a little weak, but we're not going to be talking too much about that today. Today's discussion is going to be answering, are we still in a bull market?
That's a great question.
It's a great question. Yeah, I mean, I just want to answer like the collective big question, and we're going to go through many different angles today. Everything from, let's see, the business cycle, to earnings, to the size of the different asset classes out there. When I say asset classes, we're talking about real estate, equities as a whole, treasuries as a whole, commercial real estate as a whole. We'll talk about private money or private market valuations and like WeWork, how the value disappeared and how that could be significantly impactful to the economy. We're going to talk about the recent hot IPOs and how they're performing. So you can kind of see already like Uber, Zoom, Crowd, Slack, they're not really performing, right? So Pins and Beyond Meat's okay. That one's okay. But yeah, well, it's still holding it sideways, but we'll see. And then we're going to talk about, you know, just the acknowledging like the last 2 years was just really a sideways movement in the markets, nothing much. And then we'll also talk about corporate debt, which you guys kind of know already, but I also have some Federal Reserve source statistics on that. We're going to talk about how leveraged the household is. What else? And then specific household leverage would be like student loans versus auto loans. So that's pretty high. We're going to talk about the repo market spike, which we talked about last time. And then, you know, what is the repo market or the repurchase agreement, and then the primary dealers and all that. We're going to talk about central banks and what they've been doing as well, right? The whole interest rates. We're going to talk about sovereign debt, and our interest payments are at record levels. And we're going to look at other sovereigns and their debt levels as well. So it's really like a complete things that are on Kay's mind as of late, like what's going on around the world. And then we're going to look at the FANGs a little bit closer, because last week I had it on, but we didn't really look at it. But I want to.
This is one that's quite fascinating.
Yeah. We have to look at the FANGs because it's showing a lot of weakness, right? We'll look at that.
This is an unusual time. I mean, this whole process of the possible impeachment.
Yeah.
We've seen spectacular volatility.
Yeah.
Right. I mean,
Yeah.
the company's going down 25%. You know, in less than a month, right?
Yeah.
So I mean, that's not because of the company came up with a new product. It was a dog. It's just the fundamentals of so many companies is under attack. So.
Yep. So I see a lot of weakness in the market because I'm looking at it maybe at a little higher angle, and I'm just trying to find the best way to play the markets today, where there's substantially less risk and, you know, a good amount of upside. And everything, I mean, I don't want to be too biased, but everything seems to be pointing towards gold, right?
So one question, like, you know, you just mentioned that one of the primary drivers of this bubble or signal of this bubble is that, you know, a lot of enterprise people have borrowed a lot of money and they've bought back a whole bunch of their stock.
Yes. So corporate buybacks, yes. Yep.
So when it begins to unfold
And
the other way and they start selling their own stocks, would that be a leading indicator that, the
So
market
we're
is-
seeing that today.
Yeah.
We're seeing a lot of executives sell out their positions, right? Like what was that one company, was it Coupa? Like some of the executives of these hot, SaaS names are selling out. I forgot which one. So we're seeing that trend as well. We're also going to look at, the strong high growth companies are not really doing well. Workday's a high performer.
Right.
This is Workday right here. It's not really doing well.
That's
So-
a remarkable one. Look at that one. 230 down to 100 and whatever in less than 7 weeks.
Yeah, same thing
Right,
with Twilio, MongoDB. We'll talk all about it. I'm just
Yeah.
kind of breezing through, and then we'll talk about real estate prices, how they've been mostly muted sideways. I honestly don't think there's a real estate bubble this time around. That was specifically 2008. This time around is more of a corporate bubble and sovereign bubble, which is in a way more significant than real estate, right? Consumers might not be overly exposed to stocks because they don't really trade as much, but it kicks back to the jobs, man.
Yeah.
So this bubble, if you think about it, it's the sovereign bubble, which happens like every 100 years. That just kind of tells you like the average of every Monopoly game is like, let's say 2 to 3 hours, right? So the average of every empire is like 100 years. I'm sorry. Yeah, so we're gonna look at the local pockets, the local pocket real estates, and just see the price movement, the price action. Then we're gonna look at commercial real estate as well. I'm gonna talk about cap rates, how it's at all-time low. So commercial real estate is even expensive. Global trade issues, volatility's been quiet. Global PMIs. This is a new updated chart, so that's pretty cool. We're gonna talk about SoftBank as well. How like WeWork's down, right? Who owns a significant position in WeWork? They do. So the biggest VC fund out there is taking a hit. That could mean quite a bit as well. And it kind of generated like a trade idea for Alibaba because they own like 26% of Alibaba. So maybe that might be a put position on Alibaba. We're just gonna look at SoftBank's investments. What else we're gonna look at? Their other bets. Oh, someone's coughing. And then the investors, right? Because like Uber's down significantly, which is like Saudi money. And that tells me like they're gonna have to probably liquidate their Alibaba position to kind of, satisfy the other losses that they're experiencing right now. Then we're gonna talk about the demographics as well. I think that's changing and that's important as well. And the trends in Google search, which you guys saw last week. So it's really a collective view of how I feel about the world today. I hope it means something to you guys, but yeah, that's what I geek out to. Before we start though, guys, any questions, any stocks you want to look at?
Is Alibaba listed on the New York Stock Exchange?
It's listed, ADR, yeah, and it's really big too.
Sure.
Yeah, yeah.
So they probably went down quite a bit this week, right?
They did.
Trump.
They did. Well, it's not just that. I also feel like the Alibaba 26% position could be like that's $100 billion gain they have on Alibaba, if I recall. So if they're losing on WeWork and Uber, they're gonna need some money, right? Yeah.
They're losing on everything then.
Yeah.
Well, it's some fascinating companies. I mean, look at Roku, right? Loses basically almost 60% of its value in less than a month, right? I mean, just think about how much that is. And that's how many billions of dollars lost every day, right? Because of course the Comcast move. So is that company doomed, or are they, more of now this company's ripe for 50% off that might return a year from now?
I mean, from a bigger level, guys, like I just feel like a lot of names are getting hit right now, and even though the stock indices don't reflect it, under the hood reflects some damages that. I just don't feel comfortable doing the typical momentum trading that I do. I feel a lot more comfortable in something like gold miners that are below book value. Something like let's see, AAU is it? That's AUY I think. AU's the South Africa. Let's see, AUY. So I feel more comfortable in value stocks. So this one's trading at 0.78 book value. So this is below all of its assets. Cheaper than all of its assets, right?
Which means it must have massive losses,
Yeah. So that's true. So this is all in anticipation of higher gold prices.
Well, book value on gold mines is a little different because I don't think you could liquidate it. In other words,
Easily.
The gold in the ground is what they're counting, right? If they own however many billions of...
you know what, that's a good question. Like the counting of the assets, right? It could be the counting of like the equipment too.
So as they're selling to get profit from the gold they mine, their book value might actually decline.
True.
as they-
I wanted to add this picture in here as well, so I really liked it. So,
I've got a question.
sure. Someone from online.
Thanks. The Alphabet, Google, and the price of oil just since the attack in the Saudi Arabian oil production facilities. I'd like to see whether there's any money that's been moved from oil futures contracts and such, since we're on commodities, to Alphabet Solve for X Project Foghorn. Do you know about carbon neutral fuel? It's like dialysis of carbonate from seawater to make kerosene, jet fuel, diesel, and gasoline.
Right.
They can do it from retail power for $5 to $10 a gallon. What is it from nighttime off-peak wind? And I think that whole dynamic could be, from the price of oil, or the volatility of oil, I should say, given that huge attack and the whole the precipice that the world economy is on, that liquid energy addiction. Is that moving into Google at all?
Man, that's a pretty sophisticated question because I don't know the specific Google project that you mentioned. If you ask me from like an oil price perspective, that one's pretty
I'll
tough.
put it in chat on the.
I'm sorry?
I'll post the URLs for Project Foghorn and
Sure.
the stock charts and the commodity chart in chat.
Yeah, I don't know if this would be any value to you, but I do a market scan every week, and I want to see where money's moving every week, right? So just basically sector rotations and all that. And I think this week, if I recall, or as of late, I've been seeing a lot of money flowing in just two basic areas. A lot of oil and gas companies and a lot of gold miner companies. And that's pretty in line with like my view on global macro. So I do view the world as pretty heavy right now in all dimensions, from demographics to financials to economics to geopolitical. And I feel that we're at a point where they're most likely going to devalue the dollar, which is going to help gold, but then that's also going to help commodities. So undervalued securities like oil and gas are really going to outperform as well. That's sort of my quick take. And when they devalue the dollar, I'm also looking at emerging markets as the segment that's going to be really outperforming in the next decade. So emerging markets would be anything from like Russia, India, China, Brazil, and so forth. You just have to kind of go deeper in there and then pick out the specific securities that you feel will outperform. Okay, all right. I don't know if that helped, but let's get started.
Yeah.
Okay,
Thank you.
some new faces in here. Welcome. Let me know if you have any questions. I typically just go through this document right here. This is an investment club. I run this every week, so welcome to one of many. Feel free to chime in anytime. Did anyone else have any questions or comments about the markets? Okay. Well, shoot. Let's start. Today's technical discussion number 134, and I want to answer the question: are we still in a bull market? Because I just feel like as of late, when I'm analyzing, screening a lot of stocks, right, hundreds of stocks, especially the really good ones, they're just not really performing. The recent IPOs are definitely not performing, and we're just seeing gold at a 6-year high. Looking underneath the hood, we see sovereign debt and so forth. So I really want to take a look at it again and give you guys like a very big picture view of the world and what angles or situations there are, and then you can kind of derive your own investment thesis. But before that, I want to update Silicon Valley Mixer number 19 yesterday. So we do have an Instagram page. So on top of this investment club, I also do these networking events right here. And this was yesterday's turnout. It was pretty good. Yeah, so I was actually really surprised because around this time, Q4 of the year, usually the attendees cut back. So maybe the economy is still strong locally. I don't know, but that's the event that I host every week. It's really my long-term investment effort into building a network, or really a bridge to Palo Alto. It's not that much of a big bridge because we're so close in proximity, but the closer I could get to Palo Alto, it'll be beneficial to break into venture capital and so forth. Yeah. So that's another topic that we talk about. But anyways, I wanted to start with some few quotes that I always do. Here's one that I saw this week that I really, really like. And it's by this trader as well as a lady. Her name is Stella. She said, every new person you meet is potentially a plot twist in your life. And I was like, man, that is just too good. So I met this gentleman yesterday. Out of the many people that came to the mixer, I only had a chance to really connect with like 4 or 5. It's just people ask a lot of questions, right? But I connected with this gentleman. I think Bonnie, who's online, she met this gentleman at Toastmasters. He wants to now partner closely together. Now, I'm only bringing him up because he worked at 2 hedge funds that, this investment club was kind of observing. Maybe one seriously, but the other one we weren't looking at so much. So I do have the Guru Focus links right here. We're going to look at the portfolios that he used to, this is the 2 companies that he used to work at in San Francisco. So one was Passport Capital, right? He used to work with John Burbank, the guy who is religiously long on uranium stocks, right? And then the other fund that he worked at was Parallax Volatility Advisors, here in San Francisco as well. And they manage about $91 billion. So we're going to take a look at the portfolio. But I just want to mention, do a little intro about who he is and why I found the conversation so beneficial and would encourage anyone and everyone to go out and network in Silicon Valley. Basically, this guy's pretty qualified. Stanford graduate, MBA, CFA, and then worked at 2 credible hedge funds. Now he's going to start a commercial real estate investment fund where he wants to develop commercial real estate. And he's looking at me to partner up just because he needs help with fundraising. So he's looking to raise $200 million. That doesn't, $200 million sounds a lot for people who don't know the numbers, but actual reality, it's not that much. It's a pretty small fund. But I spoke with him a little bit, and I'm pretty in line with his thesis in terms of commercial real estate investment. So the strategy really is that he's looking to buy the land at a cheaper value, and then build something on top. Building on top, I don't know exactly which model, but let's say he wanted to build something like an office workspace model. You build that, and then you start, depending on how many units, you can start leasing it out to startups for equity. So that's sort of the game plan that I got pretty excited about. But we'll see, because this environment is pretty scary. Commercial real estate is overvalued as well. But coming from a developer perspective, it's a lot less risky, I'd say. Let me just mute this person. Yeah. So, anyways, that's the person I met yesterday, and let's look at the few portfolios that he used to work at. So this is one right here. This one manages $91 billion, but in his words, they're not really a trading firm; they're really a market maker firm. But check out the portfolio right here. They got like S&P 500 puts, a ton of them, 70 million shares. Now, I'm not quite sure how Guru Focus measures this in terms of shares or contracts, but I would say it's shares. So in reality, it's really like, this many contracts.
How do you know it's formula?
That's what I'm assuming, okay? Because I don't think anyone would buy 70 million contracts. Then that'd be like 700 million shares. No, that doesn't make sense. So I think this is the shares equivalent. And then they got puts on EAFE, which is quite substantial. Now, I'm just going by shares, right? We haven't done by value-wise. Their biggest value position is a mixture of S&P 500. So they're more puts. Yeah, they're put and call, but they're more puts than they are calls.
It doesn't say like when their expiration is?
No, it doesn't.
Well, they're market makers, right?
Yeah, I think they're more market makers.
So that's probably why they have.
So I don't know exactly how they operate, but this was an interesting fund to look at, and they're located here in San Francisco. So there wasn't much to talk about this, but just kind of seeing another flavor of portfolios out there really helps. Ivan, did you want a seat over here, or you okay standing? Hey, I mean, it's up to you.
Just a question. There are long positions, right?
Is there what?
Basically, they're buying puts and calls. They're not selling them. Is it, or
I don't think we have the capability to get access to seeing their selling of puts and calls. Yeah. So, I mean, we have to remember these are private money managers, and you got to respect their portfolios. We can't know everything about the portfolios. That'd be a little creepy.
for hedging, though?
Second?
Really is for hedge? No.
Maybe. Again, guys, we're not getting deep into this portfolio. I'm just showing you the different flavors out there, right? There are some funds out there that just carries option contracts all day.
Lots of puts in this portfolio.
Yeah, it seems like primarily puts, like quite a substantial position on puts.
Yeah.
So I mean, look, if you go long calls and puts, which one are you more neutral, or do you lean more towards net long or net short, right?
Depends upon how much volume and at what price you have.
Yeah. So that's Parallax Volatility Advisors. I'm gonna dig into his mind a little bit more. Like, hey, what'd you learn when you worked over there? And then he told me something interesting about John Burbank, and I had no idea he worked at these two funds. I just pulled up. Well, he told me about Parallax or whatever. And then I asked him, like, well, there's this other guy in SF. Do you know this guy? And he was like, dude, I used to work there. So Passport Capital. This is Passport Capital and John Burbank. So he told me something really interesting about this guy. This guy's massively long on uranium, right? But what he told me is that this guy actually lost 80% when he joined. 80% of his fund, right? So he said that, so the guy I met joined the fund in San Francisco when it was about $6 billion.
Holy cow, I mean, in 90 days, it went from 6 billion to 1?
Yeah.
Everyone
Holy
can
shit.
do that, you know.
Yeah, so that guy had like a serious derivative exposure. Well, I don't know how much he would be able to tell me, but the gentleman I met worked at that guy's fund when it was at 6 billion, and then left when it was like, 1.
See, there's always a silver lining here. If you lose $1,000 on a stock, just think, that guy lost 6 billion. So in the big scheme of things, you only lost 1,000.
That's what I'm saying. That's what I'm saying about this investment club.
It's like, in the big scheme of things, it doesn't sound as bad.
Yeah, so
It's not as good for it.
yeah, it's not his money, but now you see more of the reality of the game, right? Because when you go, if average people go out there today and talk to financial advisors, they'll tell you that the financial markets are infinitely going up. The really bad ones.
Yes.
The really bad ones will tell you that. Like
Well, what this really tells you is that there's no certainty.
There's no
with
certainty.
any
Exactly.
type of investment, because if it was,
Yep.
these guys wouldn't have an
Yep.
80% decline in 30 days.
Exactly.
So I mean, if it was that simple, these guys on CNBC and so on will all be billionaires, but they're not.
Yep.
And if they can't get it right, neither can this guy.
Yep.
So place your bets and realize that the risk you have is the same risk as everybody else who thinks they're an expert, but is just as in the know, unknown.
Yeah. Now, the guys who I feel like, well, I mean, keep in mind, this guy did 20% for every year for 16 years,
Yeah.
right? And then I don't know what went wrong in 2017, but he went down 80%.
That's incredible.
So he let himself slip, or didn't take a cut, or didn't cut his losses, or just too much exposure.
Is it his personal money or
Through
the
the
money?
funds, like he just changed his.
Oh, well, the guy said that the guy that
he
worked
said he
there
lost.
said that he actually lost 80% of his portfolio.
Wow, that's
Yeah,
amazing.
it's wild, right?
16 years in career just down the drain.
Yeah.
He
Now-
saved a lot of money in this league.
Yeah. Now, if it's anyone that I look at a lot, I feel like Jim Simons is probably the best example of like who you guys should follow. Him-
That's just
I think we're good. Okay. Yeah. So Jim Simons, no matter what security I look at, I mean his fund is so big. He's managing 100 billion, and he's worth about 2.21 billion. Whichever stock I look at, this guy always comes around. So if I were you guys and wanted to like learn more about this game, I would start listening to him on YouTube. I'm actually going to listen to him more at the gym. Like when I'm working out, I'm going to listen to this guy and just see like what insights I could get. Very credible source. I think SK used to go to the same university as him because he recognized the name before. This guy, Stanley Druckenmiller, George Soros, those are the guys I really respect. This one now, after realizing like, oh, okay, he lost 80%, now I'm wondering like, why is he playing very carefully? Because most of his position now is, look at this. So Saudi Arabia, he's long calls on that one, 3 million shares. CCJ is uranium, and then silver, more uranium. Large cap China, put, which is interesting because Ray Dalio is long on emerging markets. And then HYG, high yield corporate bond. Okay, this one makes sense, and so forth. So his biggest position really is uranium, and silver, and in Saudi Arabia. What do you guys think of his investment thesis or his portfolio construction? I mean, this is
By value?
Pretty-
He's getting more conservative.
yeah, he's getting a lot more conservative, right? I mean, he's 50 something and down 80%, which is like 5 billion of his portfolio. That really hurts his reputation, but as a money manager, he still gets paid. Yeah, that's the crazy part. Anyways, that's the guy. That's the guy that I met at the Mixer Guys. You just never know who you're gonna meet, so get out there and network. But to me, I think that was a win, and I personally think it might be that new relationship that could potentially be a plot twist in my life. Who knows? The Mixers wouldn't have happened if I never met SK, by the way. So thank you to SK Online. I always like to start these lectures off with a positive quote. So this is the one for the week. Happiness lies in the joy of achievement and the thrill of creative effort. Franklin D. Roosevelt. Another one by Ray Dalio over here. So he started talking about being a hyper-realist, but I really just want to read this part right here. He believes in making dreams happen. To me, there's nothing more better in life than doing that. The pursuit of dreams is what gives life its flavor. So it's not so much about, when people admire like celebrities or musicians or whoever, you guys are admiring like that moment of where they are. But keep in mind, it's like, how did they get there? There's a huge pursuit and a lot of effort and a lot of like sweat and tears, I would say. So enjoy the sweat and tears part of it, or the chasing of the dreams. So to give life more flavor. I don't know if that's motivational for you guys, but for me this week it was really good. And then this one's a little more of a not really a quote, but a modern statement or whatever. You studied for 15 years, but somewhere out there's a nerdy teen who learned Vue.js, I don't know what that is, in 2 months on Udemy and made a Tinder for Cats app that's making more money than you're ever gonna make in your entire career.
Sure.
Right? And this is some of the realities I've seen, because when I worked at Silicon Valley Bank, I saw the massive wealth differences between people who had PhDs who were worth about 3 to 5 million. Like there was a lot of those, but then there was very little billionaires who didn't have any degrees really, who just had like a bachelor's degree. It's weird that when in private banking, when you do a credit analysis of a person's profile, right? They actually ask you for your degree. So I mean that was what we did. So that was pretty cool. Like what technical degree you have, and that's based off the loan calculation. But anyways, this statement right here really explains the whole how technology is just really disrupting everything. And so we have to constantly pay attention to technology. At least that's my belief of it. So yeah, execution is key. So with this statement and SK walking in at the perfect time, this week I also had a meeting with the guys. This is SK right here. They introduced me to some Indian food called dosa. Is it dosa? Yeah, so I tried that for the second time, and again with SK, but I also tried this coffee for the first time. But the picture is not really what I want to focus on. I want to focus on some of the brilliant conversations I had with them. So Barath, he's sitting on my left over here in this picture. He said some people are just wired for 9 to 5. And I was just like, wow, that's a really good quote, or that's a really good statement. I want to keep that, because he was talking about, if I recall, you're in here today. You're talking about your director, right? So he responds to his director, who is what did you say exactly? It was so funny. You're saying that this guy will not pursue any real economic value for the company, but instead he will pursue like a promotion instead. So I thought that was pretty brilliant and funny. And then the other one was SK. He said, ideas belong to the people who execute. Right? So these guys teach me just as much as I teach you guys, I guess. And then one last thing for the morning as well. This is what he sent me this morning, 9:55, 5 minutes before the meetup. There are 4 types of wealth out there. Financial wealth, which is money. Social wealth, which is status and network. And then time wealth, which is freedom. I never thought about that one as hard. And then physical wealth, which is health. Be wary of jobs that lower you into 1 and 2, but rob you of 3 and 4. Pretty nice. Some last minute material for me. Okay. Well, anyways, guys, that's pretty much it for the motivational part. We're gonna get started now. Any questions? Nothing? Okay. Market observations this week. So it's just my comment. It's going to be a very casual discussion that I'm going to have today. It's not going to follow the standard structure that I normally have, where I review the markets, but we're gonna blend in the conversation to how I feel about what's going on in this world. Okay. So yes, technical discussion number 134. Today we're going to try and answer the question: are we still in a bull market? Right. And if we can't answer it, then at least we could derive some solid investment trading positions or investment thesis for yourselves. So starting with this, it doesn't feel, to me, this is what I think, okay? It doesn't feel like a bull market right now. And we're gonna go over several reasons as to why. First reason, with everything I've learned, taught, and researched and all that, this global environment feels geopolitically, financially, economically, demographically heavy, right? So geopolitically, well, trade wars, right? Things happening in Hong Kong, bombings in Saudi Arabia's biggest oil facility. It feels pretty heavy. Financially, you look underneath the hood, yes, corporate buybacks, record levels, but they also have to pay dividends, which dividend expenses are at record levels. Also, sovereign debt's at record levels. But because they have sovereign record level debt, they also have sovereign record level interest payments on that debt. So financially, from a sovereign and corporate perspective, it's pretty heavy. Real estate, consumer-wise, consumers look okay. We're going to look at some of those charts and numbers. It's down below, but those look pretty interesting as well. Economically, yes, it looks heavy because we talked about the global PMIs and stuff like that. Most of them are pointing down, and I have the latest PMI charts today to show you what the numbers are. Demographically, yes, I think it's heavy because I hear the complaints from both sides. So like my friends, millennials, they complain about not being able to afford a piece of asset or real estate here in Silicon Valley, which is, I guess that's expected. But then I also hear the other side, which is the older profile, saying like they want to retire out, but they just can't sell and go to an even cheaper home. That's just not the quality that they're looking for. So it's even hard. It's also hard for the older people to retire and capitalize on the wealth that accumulated from the piece of real estate. So yes, I feel like many angles feeling heavy. The other thing, the next one is the aging business cycle. So if you guys recall, I do feel like it's been a pretty long business cycle since 2008 low or 2009 low. How many years has it been? 10 years now? Yeah, I think the machine is getting tired. And I want to point out, like in every economics book, right, they show this, they show this, this natural cycle. And I think we really have to pay attention to this because this is sort of nature to us. And it's just like in trading, right? Sometimes in trading, you'll have like a silver move that goes like this, that gets too heavy. It just needs to correct back to the line before it goes up even higher, right? So just like our emotions, sometimes we'll get extremely excited, impulsive, and then the next day we're like, why do we do that, right? Now that's a perfect example of that from a micro individual level or from a trading level. You could also apply this to a global macro level. So I believe like the whole world itself are moving together in a collective business cycle. So in every economics book, they talk about this cycle right here. And you notice that the main cycle is in an uptrend, right? And you're gonna have your peaks, you're gonna have your expansion period, and then you're gonna have your recessions. And then you're gonna have your troughs as well. And those are just really fundamental, basic cycles of life that I believe have to happen. I personally believe that we're here, and you guys always, this is not new to some of you, but it's if you put A, B, C, right? A, if you divide this into three pieces, B, C. I honestly believe we transitioned to C recently, and maybe with the way the central banks are behaving with interest rates and the whole repo event, they actually printed a lot more money. They're really trying to hold up the markets. So what's actually there? What's the scenario that they're trying to do is fighting off this peak right here and pushing it to the next expansion.
Right.
Yeah. So that's the reality right now, and I think we have to have that come to Jesus moment, right, with ourselves, knowing what's happening at the sovereign level, the printing, the monetary, global monetary level, the architecture is decaying. But why? Why are we trying so hard to keep this up? Why don't we accept some pain? Anyone want to, like what's wrong with pain?
It's just like an older person who wants to keep on, putting injections to look young.
Okay, Botox. Okay, Botox is a great example. Yeah, so it's what's the reality of that? You can't fight life and death, right? I think that's something that we all face with eventually. Wait, what? Or die trying? Yeah. So another way to look at the cycle, this is just another one right here, shows you like 3 cycles, 1, 2, 3, but just more perspective on how I feel. So On top of everything feels kind of heavy from many different angles, I also feel that there's definitely an aging business cycle that we want to be aware of. So those are things that I'm thinking about when I'm investing or trading. I mean, not so much when I'm trading.
It's your nagware again.
It's what? Oh man, yeah. I don't know why does it do this now? It didn't do this for like so many sessions before. But we have donuts here that Bernard brought. If you guys want to
It's coffee day. You get a free coffee and donut at
Yeah, they look really good. The next chart I have for you guys right here is the business cycle backdrop. So this is again by one of my favorite money managers in San Francisco, Axel Merck. It's a very recent report, 9/25/2019. This is what the earnings, or I'm sorry, not the earnings, the leading economic indicator index looks like. So what you actually have right here is the S&P 500, which is the black line right here. So for those of you who are new in here, we track the S&P 500 very religiously because if you guys recall what I said in 2001, things were concentrated in the .com type of tech stocks, and in 2008 was concentrated into real estate derivative contracts, so forth. Today, things are concentrated in corporations, corporate buybacks, dividend expenses. So that shows that things are concentrated in the stock market. So I believe because of that nature, I'm going to mute somebody. Because of that nature, just 1 second. Because of that nature that it's concentrated in equities now, I think more than ever today in this time frame, the S&P 500 really accurately represents the heart of the economy, the beating heart of the economy. So we basically look at this every week. I look at it every week. I look at it every day, to be honest.
It's okay. In 2001, obviously the .com bust was based on companies that lived on a PowerPoint deck that had no earnings, no balance sheet, but an idea. We're still valued at $1 billion, and then naturally caved in.
Yeah, and we're seeing that today.
It should never have been valued that way to begin with.
Yeah.
In the 2008, people were buying houses with no money down, who shouldn't have been buying a house, who really shouldn't have been, had way too much debt that they should have ever had on property that really had no value. So it was a matter of time before the whole thing exploded.
Exactly.
Okay, so go fast forward to 2019.
Yeah.
So what is it?
Exactly. What's the pattern today?
That's of that magnitude. Is it consumers have more debt than they really should have because more people are living on credit cards or companies are debt up the
We have charts on that. We will go over that too.
Right. So I mean, is it of the same magnitude though that we're going to see a 2001, 2008 major cave-in, or is it just more of a point of variability, but nothing of that magnitude?
Yeah. So if you ask me in terms of like positioning, I think the euphoria is the animal spirit is the same. Like it exists today, right? Unfortunately for me, I didn't play through the .com or 2008. I was too young, but I definitely study a lot, and I do want to expand my view by doing a 5,000-year analysis one of these days. One of these days, okay? That's what Ray Dalio does. But I find that very interesting. But yeah. Like you said, people are buying .coms in 2001 that were not profitable or whichever. And in 2008, people are buying homes without a down payment. Today, well, I'm seeing VCs when, I talked to some people in the VC ecosystem, and they know a lot of VCs, and they were kind of surprised talking to me because they were saying like, hey, like you haven't met the VCs that we met. And I'm like, what do you mean? Because I was talking about some of the ones that I know who are super technical, right? And they're like, well, the VCs that we know, they're just all indicator focused, meaning if that guy buys, they're going to buy. And that to me does not build like a real, true foundational venture capital investor profile. So there are some games playing like that out there. WeWork is the biggest example of most recent that popped, okay? They wanted to liquidate. For people in here that are buying IPOs, everyone keeps asking. It's funny. I've been teaching for a year, but people still ask me like, "Hey, what do you think of this IPO?" Like, you gotta be careful, man, because think about this for a second, okay? If WeWork actually went IPO, it was going to IPO at $47 billion.
Right.
But they didn't go IPO, and prices got wiped down to $15 billion. If it went IPO, and you hear everyone saying like WeWork's a great stock, it's a great company, they're going to change the world, you would have bought in at $45 billion. Right? So IPOs, and we're going to look at the post-IPOs today, which kind of blends in with the stock discussion. So we're going to talk about like Twilio, MongoDB, but also the recent ones like Uber, Lyft, not Pinterest, but Cloudflare. Well, I got a list down there, so we'll talk about that. And I'm just watching all these stocks deflate. So I'd be very careful at the moment. It just
And to answer that question, it is, I think, in one word, corporate debt. Too much of the capital has been infused into too many startups, which has overvalued them to a lot of extent, including Uber and Lyft. And that is what's going to go on. And we are seeing that with WeWork and the other Clinton IPO that just came up.
yeah,
The trend is more similar to 2001 as compared to 2008.
Interesting, okay.
so. Oh my gosh, this is so bad. Okay, I guess I'll just go back to the more modern digital stuff. I'll draw it right here. The way I view it is just like everyone's kind of piled in this this hype bubble right here called the FANGs. I won't spell it out all the way. The FANGs, the IPOs, the unicorns, right? And meanwhile, I'm seeing investors go to over here where it's like gold, oil and gas. Value stocks, right? Over here is the growth stocks. So something like a Salesforce. A Salesforce is actually really powerful. That one's holding up really well, but still, it's not growing. So this is where I think people should think about their portfolio. Transition to value, transition to
Absolutely.
below book value. It's just we're gonna go through the list. You're gonna see it today. So let's continue right here. So what I have right here again, the black line is the S&P 500, right? And the gray line is the leading economic index. Or indicator, or what's it, index. It's just showing you that it's kind of going sideways right now. And if you back test this, then you see the sideways over here and then the sideways over here. So this is just analyzing underlying economic numbers to give us an idea of where the business cycle is. The business cycle is just going sideways. It could be a situation like 2015 where they successfully propel it to new heights, but we will see. The business cycle hasn't turned down yet. It's just going sideways. So just like the stock market, it's been mostly choppy. We haven't made new highs in 2 years. Aggregate asset sizes. So now I'm going to shift over. The other things that we want to look at is the size of these assets, right? Now, if you're asking like which markets are the biggest, right now residential real estate is actually the biggest. And this is sourced by the Federal Reserves themselves. So they released the the Federal Reserve Stability Report 2019, May 2019. So this is from that report. We have most of the values in real estate, residential real estate, and then equities. I actually thought equities would be bigger, but real estate is actually pretty pumped up. Yeah, and now it makes me more intuitive with Mark Hansen. So for those of you in here who want to know about real estate prices, and it's funny too because this guy's like it's like a thought leader in real estate. He's actually here in Silicon Valley. He's a mortgage lender. I want to meet him one day. So that's why I want to go Palo Alto. So this is the guy that I leverage to learn about just real estate prices in general. And we already reviewed this in the past. You guys know his views. He sees that real estate prices, because he's an actual practitioner in the markets, right? He feels that real estate prices are pretty insane. So I would encourage you guys to take a look at this. I'll show you some of the things he posted in the past, which we looked at, but right here. Let's see, San Francisco. So this is a post that he did right here, right? And he put in these pictures. So San Francisco bubble 1.0 versus bubble 2.0. This is a guy who's actively in real estate, lending, flipping, investing in Silicon real estate. He's somewhere in Palo Alto. I might go knock on his door one of these days and just say, hey, I love your blog. He believes there's a bubble. Now, he's more of a real estate expert than me. Okay, I'm just leveraging another thought leader to kind of build up my global macro art piece.
I have a question. So this is only for Northern California. It's not about nationwide, right?
Yes. So yeah, nationwide's a little bit different. So, but he did do other major pockets, right? Like look at Dallas. Dallas just went like crazy. And this makes sense to me because now more than ever I view real estate as also like a trading position. Because if you buy $1 million home today, you're taking a $1 million position that you down 20%, 200K, and you leverage on margin, a trading margin of 80%, right? And you're betting that there's going to be more upside. Yeah, that is the case. But you have to ask yourself: is this home for me to live in for my family? Because that's completely different from this. Is this an investment position? And I'm taking $1 million position, thinking that's going to go to 1.5. Because when I talk to flippers, right, they'll casually tell me like, hey, Kay, I'm looking at this home, it's selling at 1.2. We're looking to buy it out, put in like 200K, and we're gonna sell it at 1.6, 1.7, and then they're just trading, right? That's what I hear when I talk to flippers and active investors. But the last real estate club that I went to, talking to those guys, the flippers became lenders, private money lenders. They're like, this environment's not really growing, so there's no expanding margins. So we're just doing private loans now. So it's one step back from aggressive active real estate investing to active real estate lending, which is so that's Mark Hansen, guys. I like that guy. I like what he says, and I'm gonna put an effort to meet him one of these days here, just to get more insights into real estate. But anyways, going back to the Federal Reserve numbers, right? So residential real estate is the biggest one. I honestly did not know that. Then equities, so stock markets, they feel are the second biggest one. This is actually from them counting the numbers. And then commercial real estate. Okay, this is just the collective aggregate size of the markets. And then treasuries, so bonds, and then investment grade corporate bonds. So corporations like Apple issue bonds. Collective corporate bonds are about 5 trillion. So 34 trillion is real estate value, right? Now, you have to think about this chart, 34 trillion, you have to think of it as like an aggregate chart. Meaning like, okay, if it's at let's say 34 trillion in total value, is it like that? Or is it 34 is it something like this and then 34 over here, right? So my question is it 34 all-time highs or 34 from a retracement? It's probably maybe a retracement. I think 2008 was slightly higher, but we'll see. But now it gives you some great insight to how big these markets could get, right? 33 trillion. If we print more money, this is how the central banks measure total game size. If we print more money, okay, just imagine yourself as a central banker right now, and you start printing money, right? And for some reason you see farmland going like crazy. You're like, oh no, what have I done? I wanted them to put into equities.
So he says, the last time he says leverage loans went up by 20% in 2018?
No, well, yes, it seems that way. 2018 growth percent is 20% leverage loans, but there's not a lot. It's not really a big market. It's $1 trillion. So leverage loans is basically, if you don't know what it is, so you know how there's standard loans, like you get a mortgage, right? But then like there's also tailored loans that are more sophisticated that don't fit a standard profile. Standard profile is like, oh, you got a job, you make this much money, you got a down payment, blah blah blah, right? Very standard. The non-standard, more leverage is like, okay, you got a struggling job, you're cyclical in your earnings. We're going to give you a very special loan, but it's going to be more leverage.
More interest.
We're going to get more interest basically. So yeah, it's expanded significantly because it's the market searching for upside, right? Let's say if you buy real estate today, it's at 34 trillion. You're thinking, okay, what's the aggregate real estate prices? Is it going up? Now, real estate they really operate in pockets. Pockets like Silicon Valley is very different from pockets like in the Midwest, let's say. So this is just from a national perspective. I'm looking at this to get a feel of just global macro in general. But we are going to look at local prices.
Leverage loans as a percentage of overall residential real estate will be much bigger or smaller?
I'm sorry, say it. So you say a proportion of
the portfolio of leverage loans to residential real estate, would that be bigger relative to the other parts of the country?
that I don't know. Percentage of leverage loan to real estate. Yeah, I'm not sure on that.
You made a very good point that so much of the money is not being put into a productive use in terms of.
Well, that's there's like, okay, so you guys understand systems? Like, just like think of like a systems have to move, right? The more you kind of look at life moves in a very predictable pattern, and you can aggregate it from small to micro to macro, right? Every day, people typically wake up, get coffee, start work at 9, get off at 5, have leisure at. Speaking of that, why don't I just jump into some fun time stuff? A little digress to make it fun. Let's see, data, visual, time spent. You guys will love this. Let's see, visual, flowing data. So a while back, I showed this. Let's do this. Flowing data, time spent, average. So a while back, I showed this, and I want to hold the topic because I don't want to forget what we were talking about. the average day life of Americans, right? This is very fascinating. Like this is how statisticians look at things, look at data. But this is an example of how we spend our time, our lives. This will help you if you're in business and marketing or whatever, because you want to know, okay, if most people at 6 a.m. are still sleeping, then you can't capitalize on them yet, right? So you can only capitalize on them when they go to work. So 8 a.m. they go to work, then you want to start marketing on LinkedIn, right? And then by 6 p.m. when they get off work, then you want to start marketing on Facebook. That's how you optimize your marketing, right? I mean, you're not trying to hit everyone. You're trying to... Yeah, so very fascinating stuff. I could show you guys this link later, but the basics of this.
Can I just ask a question about that?
Sure.
That's a great radiographic, and I wish that people would think of the macroeconomic business cycle as a radiographic like that, because it really helps you answer your question. I posted a couple links in chat. Maybe we can get them later on.
Sure. Hey, no, thank you, man. I thanks for the feedback. I like it. Not often that we get to chat to the people online. One day the people online will be a lot bigger than the people in the room, because we got 28 people online. Let's see. There's also a few other ones that are actually pretty interesting. Let me know. I'll send you guys this later. But it also talks about, let's see. Where is it? Is it right here? I don't want to spend time searching. I want to be respectful. Yeah, there are very fun charts in there to take a look at. I guess I can't find it, but just keep in mind that we move in a pattern, okay? But we just don't know it. And we move it in that pattern because, again, I could get pretty heated talking about this. It's because of collective social bias, or what did I say? Aggregate social bias. Meaning like we're not, because there's forms of superior authority out there, right? One is definitely someone, let's say like an officer with a suit and a gun. That's pretty, authoritative, right? And then there's some people who are religious and believe in the divine. But I also believe aggregate social crowds could act as an authority as well. Meaning, you guys saw the guy who, the guy who danced alone and then he started the crowd. You guys remember that, right? Yeah, like we that's how humans tend to behave, where we just chase whatever we hear. We're very social. So whenever I think about trading, tying it back to my investments, and I heard this a long time ago, but it was really good. Think of trading as like a bunch of cows on the farm, right? And it's like a nice green farm, and cows are just, a bunch of cows are just eating, right? And then out of nowhere, lightning strikes, and then they start running. Like they don't know which direction, but they start to run in a direction, right? They start running after that lightning strike. And then they run in a direction, and that's what happens in stocks. It'll go parabolic, momentum kicks in, and then they'll start slowing down because they run out of breath, right? The stock will exhaust itself, and then they start asking like what direction are we going in? That's really trading, and then the chart starts breaking down. So if you know that's the typical pattern of human beings and emotions, then you could capitalize on emotions. So it helps. Yeah.
Just wanted to let you know, sorry to interrupt again, but I did post that link you were looking for in the chat. I don't know if you can get to the conference chat from your presenting machine, but it's flowingdata.com, 2009, is the economy getting ready to turn around?
Okay. I definitely have to read this later, but thank you for that. I appreciate it. Is the economy getting ready to turn around? Okay, I want to respect the people in the room. There are quite a bit of people, but we will definitely take a look at this later. This looks interesting. So yeah, guys, going back to this over here. Now that you know like collective human nature, right? Now, one last comment is I say social aggregate biases because a lot of us can't challenge that. A lot of us are like the cows that when the lightning strikes, will join the herd. But if you could really digress from the herd, I think your life could go a long way, in my opinion. So when they say, don't talk to strangers. Well, look at Kay. He talks to strangers every day. All right, my parents, right, don't invest in stocks. I invest in stocks every day. What else? People are saying go to school. Sometimes I wish I didn't go to school, right? Well, I mean, I didn't come out with a lot of student debt like some people. I have some, not really friends, but acquaintances that came out with 100K. And I'm like, wow, that's crazy.
100K debt.
Yeah, 100K in student debt just coming out for the first time. So, you had a question, bro?
No, sorry.
Oh.
I just might come in.
Yeah. Well, anyways, try to challenge the norm, I'd say, because that's how all venture capital startups start off with. Like when I'm meeting with startups, they'll tell me, hey, this is my idea. No one's got it yet, but I believe the world's going to operate this way. I like it. Let's double down. Let's help you grow it. So the example is Nero, right? So this week I met with a CEO of a company called Nero, and I'm going to help him grow this application. And I'm doing it purely out of just genuine effort to help this guy because he spotted the opportunity to help me because it could grow like the tech community with his social app. And I played with it. He demoed it for me. I respect the guy. He bought me a cup of coffee. That's all he paid me. I don't get equity. I don't get money or anything. But just out of like the kindness of helping another human being, I'm going to help the guy and see where it goes. So we can get like a lot of people in Silicon Valley on that application. It might be pretty interesting. Anyways, back to this, okay, guys? Just be mindful that the money flows around, and it'll aggregate in specific asset classes. Now, also remember that these are asset classes, but remember there's also subsegments of real estate, right? Distressed real estate, subsegments of equities, which is like, it doesn't even talk about derivatives, but small penny stocks, small cap, mid cap, large cap, commercial real estate. You got offices, healthcare, industrial, commercial real estate. This is just the aggregate. Okay, we don't know which individual sector is performing. Now you kind of understand the stock market more, right? You look at the index, and then you look at the sectors, and then you look at the industrials, and then the specific businesses. But that's that on the aggregate asset sizes. So they're getting pretty big. The next thing I feel, to answer the question, are we still in the bull market, is news of hot private valuations are tanking. So, for example, WeWork canceling their IPO and CEO stepping down. This just might be the big move that sets the tone for other VCs participating in this segment. So this is the chart right here, the valuation, right? For some reason at 20 billion, it just decided to double near IPO date. Okay, it's like, no, we're gonna IPO, it's gonna be a lot more. It's gonna be 47 billion. Who's saying it's 47 billion? Maybe SoftBank, they bid it up. So, before IPO, they decided to cancel it, and then this is how prices are getting wiped out. So now you kind of understand the private markets. If you invest in the private markets, there's a chart. There's always a chart. You're always investing through some form of price and time, right? Price, time, and volume. So I think this is a pretty substantial chart that it was super hot in the news media, right? Everyone read about it, but I don't think people truly understand what's happening right here. Like this could be the cherry on top for private markets, right? Because what was it saying? Like, well, okay, Sumo Logic, Battery Ventures put 100 million into Sumo Logic in Palo Alto over here. Is it really at that valuation anymore? Look at WeWork. Right? So if things start tumbling in the private markets, hey, did you see WeWork? I don't think that's the valuation anymore.
They're probably not profitable, right?
They're all not profitable. They're all
right.
These are all startups, right?
So that's clearly the thing. You look at Peloton, look at the opposite.
Yeah,
look
Peloton
at,
too.
Zoom.
Yeah.
Zoom goes public, it's profitable, goes up. Any company that is unprofitable,
Yeah.
filing for an IPO like Peloton or other, people are losing faith that these are the ones to buy for 5 years from now.
Yeah.
So they're more critical
Yeah.
of the vapor of the story that I'll be profitable eventually.
Yeah.
So buy me now, and the people are becoming more risk averse against those.
Agreed. And I'm telling you guys this because I'd like you guys to be protected when you see the next IPO. Understand some valuations a little bit. If you don't understand valuations, I'm just a text away.
Absolutely.
Just ask me for my opinion. I love the challenge because it's like the introduction of the computer for the chess player, right? Before the computer, the chess player could only play 50 games a day or whatever. That's quite a bit. But with the computer, they could scale up to 300 games. So I welcome all the questions because it allows me to think about it and see okay, does this valuation make sense? So ask me anytime. But yes, this is I think this is a kicker right here, right? The biggest venture capital fund ever, and we're gonna look at the charts comparative size, took a big hit on this, okay? If they took a big hit on this, they also own a big public position called Alibaba, 26%. They also own NVIDIA, and they're gonna have to look for liquidity to service their, yeah, exactly. So just expect some trickle down economics over here. It's just, again, another angle we're looking at. Now, on top of the private money action of WeWork, right? I honestly think it's the cherry on top that's going to kick to other private, startup valuations. is the post-IPO performances have been poor. Meaning now these stocks have recently IPO'd, and we're going to look at some stocks right now, and after that they kind of just suffered substantially. It doesn't feel like these mighty IPO names are really outperforming the markets anymore. I don't feel the animal spirits where it's like, oh, you know, okay, like MongoDB just IPO'd, or like, are you gonna buy this stock? Dynatrace just IPO'd. Peloton, man. I don't feel that energy at the moment, so it's a little muted. Instead, it feels more like a liquidity event for private investors to cash out, and that's what the charts are starting to look like. So let's look at below are some of the names of the recent hot IPOs and how they've been performing. So you guys know me. I've been trying to pick a bottom in Uber. We saw Stanley Druckenmiller, a money manager that I really respect, take a position in Uber, but I don't know if it's a starter position or is it a full position. Well, we could look at that real quick. So if I go over to Guru Focus and look at Stanley Druckenmiller, right? I'm seeing a lot of professionals buy Uber, but that doesn't necessarily mean you go and buy Uber, right? So his new holding Uber, he bought only 2.6 million shares. Weighting is 3% of his portfolio. Is that right? Oh, wow. Okay, he bought Uber at 3.7% of his portfolio. Judging from the way this guy bets, right? So this is a 50% starter position in my opinion. You see what I'm looking at? So you know how when I trade, right? When I feel like, okay, it might be an inflection point right here, I'll go 25% of my position. And then as it goes up, I'll add another 25 or 50% or whatever. So looking at Uber, he took a 3.7% of his portfolio. So, and seeing that his other position, Amazon and Netflix, he's willing to go double. So I think Uber is about 50% of his starter position. Meaning, if he were to get in full position of Uber, I think he's looking at 5 million shares to play. Right? So this might be, he bought it in a way where he thinks this might be a bottom, but now the charts are playing out, pushing a new bottom, so maybe it could go lower. But he's just playing a starter position. That's my feeling on that in terms of analysis. Yeah, I mean, Uber's not profitable at all. It's seriously risky, but you gotta remember what the game is played here. It's Saudi money in this, right? They don't want to lose, and they got SoftBank who could pool 40 billion or more money from Apple. Well, Apple's invested, Qualcomm's invested. They could pool more money to hold this up. Who knows? So I think this is a good watch, right? Again, not profitable. I forgot the balance sheet if they have any equity value. But it's a data play, right? We talk about how, moving forward, the demographics are changing. The millennials are, the Generation Z are using mobile devices. We got to pay attention to that. If this is going to be a way of life, if it's going to be the mobile operating system, then we have to watch it. And I think Stanley Druckenmiller sees that, and I also see that from a social perspective. When I look around, everyone's kind of, hey, just Uber to get to me, or Lyft and get to me, or whatever. They come hand in hand. So. This one has some downside according to technicals. Fundamentals, it should be lower, but from a technology analysis, I think this is a compelling technology to think about because there's so many users on that. So,
but they're also following a lot of these companies, the Amazon model of staying non-profitable and keep expanding.
Yeah. It's like let's say this investment club, right? Stay unprofitable. But keep expanding because it'll take you places. So in this case, you're right. They are monopolizing consumer transportation, and now you're seeing them introducing business transportation, where you could buy a business subscription, and then expanding into Uber Eats, expanding into Uber Elevate, which is like airplanes and stuff like that. So I see the long game, and that's why I want to invest in that because it's already a trend among our social language. It's in our.
That's what you just said.
Yeah.
Is exactly what someone would have said in August too.
Yeah.
So I mean, if you would have bought it at 46, it would be at 30. So you would have allowed a third of your money with the company's fundamentals hasn't changed. They haven't introduced a single new Uber helicopter or Uber, deliver gasoline to your whatever. I mean, they haven't changed anything.
So
and you lost a third of your money in 2 months.
But this is like a multi-year play. Like this will start paying out in like over 5 years.
Yeah,
it's
a multi-year play indeed. Now, if you look at S&P 500, right, the heart of the economy, what happened in August? It went down, right? And you go back to Uber over here,
It didn't
August.
go down 33% though.
S&P 500 or
Right, you're
yeah,
right. I mean-
yeah. I mean, it took a hit, but this one was really sensitive to it because it's over leveraged.
That's right.
Now it's opportunity because the way I see it is like, okay, it IPO'd, it was already overvalued. Great. Now that overvalued premium got wiped out. Maybe it's starting to look interesting from a public market perspective. I'm more of a intermediate public market investor. So I feel that I understand the size and capability of this. When I see 50 billion, it's pretty big. But if Uber could go down to 30 billion, I think that's really small for public markets, for the global dominance that it kind of has. Now, right now, technically speaking, from a chart perspective, it's going to go down lower, right? You have a clear breakdown right there. It's looking very bearish, unless that acts as a double bottom. But I don't know in this environment it's going to act as a double bottom. So again, I'm just holding back cash to play these later. These are definitely a watch because this is life-changing technology at a global scale.
Right.
But it's just not right now to protect your present value of capital. So I like it, but just not yet. But money managers like Stanley Druckenmiller, highly respectable, long-term track record, is taking a 50% starter position. So he sees a bottom is near. In terms of valuation-wise, do I feel a bottom is near? What do I feel like would make a great valuation for the stock? It's trading at a price of sales of 4, and that's really the only multiple that the markets are really looking at. That's actually quite low. Yeah, comment.
No.
Yeah, it's quite low. So I see his thesis as to why, and it's 50 billion. If this could get to 45, 40 billion, I think more money managers will consider. If it gets to half of this, 25 billion, I would definitely get in, right? Because again, I'm not playing because there's no, let's see, price to book value. Okay, there's some book value 2 times, so 2 times book value. So there's 25 billion of net asset value in the balance sheet, price of sales. So yeah, not too bad. Lyft is the one that has no book value. But yeah, if this could go to, hey, I guess if it goes half, it'd be at book value, right? Yeah, so it's just trading at 2 times book value. Okay, I see it. It's actually relatively undervalued. It's not undervalued. It's relatively undervalued. Yeah, it looks interesting, but be careful. If you really have to start, just go really, really small until we get a clear reversal right here. Yeah, the markets are just not happy about this one. Looking over at other IPOs that went IPO and aren't looking too good, but have like 100% growth. Zoom is an example. So how is it that typically when we hear 100% growth year over year in revenue sales, these securities will just scream to the moon? But right now it's just setting up a bear flag and going down lower right here, as you can see.
Right.
So testing the $76. So to me, this is great. This is great because these are names that are being adopted in the enterprise software world, and they're getting wiped out in premium value. So I just need to prepare myself right to kind of be patient and wait for things to play out. And yeah, I think it's a mixture of executives are selling. I think I saw a Gartner report that did like a CIO or CFO analysis, and the average CFO feels very bearish, like majority of them compared to like, we're talking about S&P 500 CFOs or CIOs. But anyways, this is Zoom right here.
Right.
Zoom is a watch, but not yet. It's in a downtrend. Don't play it. Right? Unless you want to put it. I lean more towards the put because you got a 4% move to the downside. Think about a 4% move. 21 billion, price of sales of 47. I wouldn't be surprised if this went down to $35.
Totally agree.
Because $35 would be more in line with today's price of sales multiple.
Yeah.
Yeah. So this is a no touch. Don't touch this. Too insane. Now if it goes up, you could get mad at me, okay? But I'll tell you, it's going up on even crazier valuations that you could be mad at me all you want. But that valuation does not make sense to me. I do not want to touch anything that will take me 47 years of my life to pay off. Mm-hmm. If I were to acquire this entire company. Considering that human average lifespan is like what, 80, 70, 75, 80 in the US? This is saying that if I'm buying this out, I'm going to start getting the cash flow, which there is none after half of my lifetime. Unless we somehow, one day live to 200 on average, then these valuations make sense. Right? Because this is already more than 50% of my lifetime. But if I live to 200, then it's only a quarter of my lifetime, right? So it's still a good investment. So that's the other interesting part. If our age demographics, meaning if we live longer, these valuations change. Because now we take into consideration, like, oh, I could live longer, I'll pay that premium. So the world is definitely fascinating when you think about it. So that's Zoom, guys. I wouldn't touch Zoom. I think it's going lower. Same thing with CrowdStrike. CrowdStrike's going lower with BlackBerry. BlackBerry I'm considering, actually, because it took a 30% dip after earnings. But yeah, this is CrowdStrike. Again, let's look at the valuation. What's the number, and why is the market punishing this type of valuation? This one's trading at 37 times price to sales, right? What I'm seeing with the acquisition in bigger corporations, what they're willing to acquire at is like 10 to 15, right? Meaning highly intelligent corporations like SAP, even though after SAP acquired Qualtrics, they did an announcement and said, okay, we get it. We overpaid for Qualtrics, but we bought it anyways for 15x of sales. This one's trading at 37 times its sales, right? Sales needs to really go parabolic, but again, these IPOs are elusive. You know, it's something that I hope could protect you guys. It is quite a bit oversold in terms of a trading perspective. I think it'll bounce back up and then go down. But yeah, be very careful. 9 times book value, it's balance sheet value, and then 37 times sales. Not looking too good. Okay. And again, why are we talking about this? Remember, we're still answering the question: are we still in a bull market? Right. We're talking about post-IPO hot tech companies that everyone was raving about. Zoom Technologies. What does it look like today? So looking over here, over at Slack. This is Slack right here. Everyone heard about Slack, right? So this is Slack post-IPO. It's still going down. Right. And let's look at some of the valuations, because I have to look at these maybe every week just to kind of get a pulse of like, okay, are people buying? Slack is from a public market perspective, it's decently priced. Now for what's his name, Carl Icahn, he thinks Cloudera is undervalued, right? Cloudera is trading at a price of sales of 4. Definitely undervalued in this market, relative undervalued. But Slack is trading at 24 times. So again, if we have that recession or come to Jesus moment, I think this could easily go down to half to $10, and that's like the moment when you want to have the most cash on hand. Yeah.
So, okay, one thing we've talked about, or we haven't talked enough about, is that if you have a portfolio of value in your assets that you own.
Yeah.
I mean, do you really want to risk a substantial amount on a company with no earnings or otherwise that goes down 50% in 2 months?
You don't.
So you could speculate that it could rebound. And Netflix, solid, freaking amazing, solid company, also down 25% because of whatever.
Yeah.
So if you took your whole portfolio, if you lost 50% of your whole net worth in life in 2 months, you'd be freaking sick, right? So you don't do it.
More sick if you're older too.
That's right, but you don't put all of your money on fragile companies that really don't have any real guarantee of being around.
Yeah.
So if you put 5% of your money in, let's say 5 of those companies, maybe 1 or 2 will come around, but you won't lose everything. Whereas Netflix, look at this one. 380 down to 260.
And this is a FANG, okay? This is a beloved FANG.
Everybody talks about it. You can't find one person who doesn't know who it is.
Yeah.
And yet, it's gone down 50% in 2 months.
Yeah.
So whoever bought it in July, when they had their birthday, and they go, I'm going to spend money on Netflix because they just came up with new movies or whatever, lost half of their money.
Yeah.
That's like, wow.
So yeah, it's what I drew earlier, right? I'm seeing the big guys, everyone really, well, okay, not everyone, because everyone's over here. Okay, everyone's at A, and A is the growth, no sales, bubble-like environment, and everyone's going to value. Everyone's going to from intangibles to tangibles.
Right.
Think about that, right? From growth to value.
Yep.
That's the trend right now for the professionals, but not for the average people.
Right.
And so I'd say be very careful, because today I'm not trying to paint like a super bearish view. I'm showing you today a very objective view of like major structural damages around the core foundations of the economy, global economy. Everything from sovereign debt to hot IPOs, things are getting devalued.
Yeah.
So I think this is the underlying right here, and I'm surprised the S&P 500 hasn't done anything, but that tells me then, okay,
I completely agree with your recommendation for purchasing companies according to cash. I think the underlying cash holdings is going to be extremely important as the volatility increases coming into the election cycle and with other sources of volatility. I just posted the top 25 corporations by cash, some magazine compiled earlier this month, if you want to look at that.
Sure.
In the chat.
Hey, thank you, Jim. Is your first time here today?
Yeah, and I'm enjoying it tremendously. I wish I could have been there in person. Sorry.
Yeah. Oh, well, hey, thanks a lot for this. I do appreciate the online interaction. And I also apologize that these days I spend a lot of time with the people in person because it's kind of hard to balance the two. Yeah. Yeah, Microsoft's number one. I'm not surprised. That's my number one favorite. Stanley Druckenmiller as well, right? 21% of his portfolio. And he's managing $3.37 billion. Okay, he's willing, as a fiduciary of his clients' money, he's willing to put 21% into Microsoft. I would definitely agree with that because it's just like it's a safe haven play. You got world-class management with a world-class portfolio, right?
Sure.
With a, many years of track record success, and then they also have a growth story, right? It's nothing better than a big giant entity, a big enterprise ship, with a growth story, right? That's like SAP and Qualtrics. That's like Oracle acquiring, what was the recent acquisition? They acquired something for growth. But yeah, I mean, Microsoft's growth story is Azure, I feel. Yeah. I mean, there's more tech people in here that probably know this better than me. But,
So last one said Japan for Cisco?
last one says Japan. Oh, Cisco Systems. Country is Japan.
That's where their IP is.
Amazon, Facebook. Yeah, Facebook, I agree. They cash piles. This is interesting. Huh?
Central Japan Railway, US.
Yeah.
And we have Walmart.
Yeah. Yeah. So just be aware right now that there's a huge transition, right? Right now, I think it's mostly executives that are selling out these stocks because they know if you're in the market like CrowdStrike. If I was the CEO and I knew about you're pretty smart as a CEO, I'm assuming, right? And if you know that global macro is kind of heavy, yeah, I'd be looking to sell premium shares, right? My shares are overvalued. I mean, think about the WeWork guy, right? Company valued at $47 billion. I don't know what price he exited. Imagine if he exited at $47 billion, and then it tanked down to $15 billion, and he's just like, whew. that was a good play. But it's highly disrespectful to shareholders because now that you kind of understand stocks more, it's a public game. And if it's a public game, everyone has the ability to sue and all that. So it could get pretty messy. Who knows? But yeah, this is Slack right here, guys. I think this one, what did I say? 20, at the time we were talking about 20 to 20. Hey, it's hitting those levels, but still pretty scary in this environment.
So can I just make a quick prediction?
Sure.
So I think October's volatility will even be higher than September, and every company you mentioned, of CrowdStrike, Slack, Working, everybody like that will go down another 10%.
Yeah.
So buyer beware. I mean, they're all, people are kind of losing their, people kind of, you start to see people that can't stomach paper losses.
Yeah.
Right? Now I'm down 10%. Oh, now 30%.
Yeah.
Now 50%. Holy shit. I'm going to take my loss and get out.
Yeah.
And so these stocks will keep going down. And the whole China thing, China now has the president under a lot of pressure because he's looking for a Hail Mary. I solved the China deal, so China knows that they've got the leverage against him. Mm-hmm. And in October, that could be deadly, so that these companies that are living on crazy valuations are likely to go down.
That's
buyer beware.
It's already happening, but the broader markets are not showing that, and that's interesting. Now, I told you September, October typically are cyclical months, right?
Right.
Or the worst months for every year. Just want to say that Monday's the last day.
Right.
So let's see if history or statistics actually play out. So September, October, again, are always the scariest months. It's kind of funny because if you think about it, if September, October are the scariest months, and then you see the sellout in August, it's like, oh, we're getting ready over here for September, October. So yeah, I see a lot of we're doing the analysis today. Let's go to the next one. So that's Slack, guys. Let's look at Lyft. Right, Lyft I tried to trade right here, didn't work out, stopped out. It looks like it wants to go lower. Same story, lower. I think the multiple is higher than Uber, but Uber's bigger in terms of entity value. Price, actually no, it's the same. Price of sale is 4, and they actually have some book value. So this is not looking too bad. I already know that if things recover and we go back to normal, these are going to be my heavy plays because these will, okay, when there's blood in the streets, right? That's when everyone's like cash crunch and stuff and they don't have extra money. I think that's the best time to go in, really. I'm already thinking in my head, how am I going to play this recession? There's many dimensions I'm going to play. One is it's definitely going to weed out the players that are fraudulent, that are not true investors. Like those VCs that I mentioned earlier today that are, hey, we're just betting on indicators. If that VC buys, we're going to get in too. Those VCs will disappear, and the solid ones will remain. And so I'm going to hunt down those guys and network with them. So there's a lot of effort, but yeah, I hope this investment club won't disappear in a recession either. I don't think so. I don't think so. I'm gonna. You guys, I think if you've been here for 2 years and we had volatility for 2 years already, and I'm still here, I think we're okay. Wait, what?
That was a bull market. We got us really funny.
Yeah, the last 2 years. So, yeah. Anyways.
People coming here, right? It's like you keep showing us chart. It's also hurting us. Then I'm like, oh no, I'll take it remote and sleep off.
So Lyft is pretty much the same story as Uber, but not right now. Technicals. Pay attention to technicals. Technicals are basically, technical analysis is a representation of what the market participants are doing, right? If I had insider information, the only way for me to reflect that is to go make a trade. Okay? So in a way, you could derive insider information legally through price action, right? So study the prices. I don't know why all these finance degrees, when I was in college and going for my finance degree, every professor was like, don't study technical analysis. But then I'm sitting on an interview with Stanley Druckenmiller and he says, I wait for the bull flag to break out and then I pile into the trade with his deep voice. So it's like, you're really using technical analysis compared to fundamentals. But now that I know both worlds very well, I think it's all fun and great to know. Fundamentals, technicals, sentiment analysis, global macro analysis, everything. Technology analysis is a new one that I think I myself am kind of crafting my own ways of analyzing technology. Because there's only a very small breed of people who could really evaluate technology. Because now you're looking at data, software, technology stack, infrastructure, all that. You have to understand the players in the game. Because technology is disrupting everything. The real question is, what did technology not disrupt? So new forms of analysis are emerging that I don't think people in the East Coast are seeing, but I feel like we see it here. Datadog.
What is that? Datadog?
So Datadog was a hot one that IPO'd. Very solid year-over-year sales.
It's a data monitoring company.
Analytics platform. So 82% year-over-year, right? So this one's doing really bad as well. Price of sales at 35. Yeah, 9 billion valuation. This is gonna go to 5, man. It's just way too big. It's like hey, okay, you know me, right? It's like saying like I'm a Olympic sports person, and I'm obviously on the computer all day researching stocks, right? And but you're betting in real time currently that I'm valued like a Olympian when I'm not. So this is overvalued, and we're seeing the global environment turn around. Again, we're still on the segment today to answering, are we still in the bull market? The segment of post-IPO stocks that IPO'd recently. So these are all recent IPOs. Again, Datadog not doing so well. Likely to go to half, realistically, from a public market experience opinion. DT, Dynatrace. This is another hot one. I know you talked about this one in the back. Let's see, DT. Same thing. So price to sales. This one's okay. 12 application software. Yeah, it's in a downtrend. I wouldn't touch it. From a technical perspective, I mean, however you want to draw it, you got a pattern playing out right there, maybe. But you definitely got a new low right here, and that was a pretty big low. Friday, 5% move down, and also look at the distance right here. Recent IPO. So don't play these. I mean, this is probably a great day for like short ideas, but yeah, another trend right there.
You can't short it when it goes down though, right? has to be 3 consecutive upticks, right?
Yeah, there's a rule on it. You can buy puts. This one was Cloudflare, which we analyzed a few weeks back. Let me make sure on that. Yes, Cloudflare. So same thing, right? IPO pop right there, and then all the way up, and then now down. What's the price of sales on this one? 2024, which is okay. To give you guys a better understanding, this is what I drew last week, and I realized I should have drawn this a lot sooner. So let's say we have a valuation band, right? And this is where I feel like the markets are. So right now the markets are, let's say in the public markets, it's 15, for software stocks, it's 15 times price of sales. So all the ones that you saw like Slack, CrowdStrike, they were all like 37.40, right? When I feel like the market acquisition rate is about 15, and then Cloudera is at 4. So that's why I say it's relatively undervalued. So that's my valuation analysis in my head when you're buying software stocks. If it's at 4, it's pretty undervalued. That's why I decided to get some BlackBerry on Friday. I know it looks bad, 30% down, but BlackBerry is trading at a price of sales of 3. Again, I don't normally play beat down software stocks, but the environment has significantly changed, and I'm trying to explain to you guys today, and that's why I'm playing this. Because normally, in a great environment, I'm playing something like a cyber, right? And I'll show you why. I'm playing something like this, where it's just like easily going up, right? It's kind of like Twilio before Twilio right now, just easily sailing up. That type of environment, I play momentum, but now it's shifted to relative value, deep value, whichever, gold miners, and so forth. Pinterest, also recent IPO, relatively recent in May, breaking down now. So it had a bullish gap up right here. I should annotate because it helps you guys a lot better. So again, I always look at the daily for new people. Switch over to blue as well. It IPO'd right here, and it had a pop because everyone's like, oh, it finally IPO. Can you kind of assume like maybe this is less intelligent money, maybe, right? And then maybe after a certain amount of period, big money, large drop right here, someone exit really heavily on one day, and then that kind of made it go down. Established support right here at 24. So we know 24 is support. Again, we're just practicing a little technical analysis. And then at that support, it spiked up, broke that little trend line right here, and then set up a falling wedge right here, where it broke up again right here, right before earnings, and then during earnings, it had a huge gap up on volume. Typically, that will have a follow-through move, and it followed through right there, right? High volume gap up, follow through, and then it got exhausted, and then failed at $34 price area. What happened when it failed 34? It really tanked, right? And then when it really tanked like this, it set up that pole to create this flag, this bearish flag right here, and then what happened next? Further decline right there, and then lower it went. So that's how I do my technical analysis, right? Now we know the story that it went IPO and how it popped. The main concern I would say is will it clear? If you're in Pinterest, will 26 hold? If 26 doesn't hold, I mean it would bounce like this, but if it breaks, it will go down quickly to the next support, which is 24. So I typically buy around whole and half numbers. So $24, 24.5. I don't really look at it when it's like 24.67, right? Unless I'm lazy and do a market order. But I tend to eye my support at those whole and half dollar numbers, and also price support.
I would also say, right, for the startups, there is a 6-month lockup period.
Yeah, there's that as well.
Typically, right, within just before that lockup expiration, they normally go down as well.
Right.
Yeah. From a visual perspective, I feel like the current environment looks something like this, right? Where we're all the way up here, and I think we just need to correct, down to the mean line.
Yep.
Right, reversion to the mean, they say. If we don't, then there'll be a reversion to the expansion, where it'll go up even higher. But pins trading at 16 times. Relatively lower, but it's not B2B enterprise software, it's B2C. So B2C has a different type of valuation. But technicals look really nasty. I wouldn't play this on the long side for Pinterest. Though Pinterest is a very solid business, I'd say. I think at one point we did a demographic analysis of Pinterest. Majority of it is women who are participating on the platform. I think it's like 70-30. Pretty interesting stuff. So if you're a female doing a female business, e-commerce business, a great solid channel, marketing channel is Pinterest, right? Just because the stock's not doing good, the business is still okay, and it's still a great marketing platform, right? There's many ways to make money, and this is just one of them. It wouldn't make sense to, if I was like, okay, if Kay was a female, I'd probably post stock stuff on Pinterest to develop like a female, oriented investment club. Let's say. Huh?
There's a lot of good visuals.
Yeah. Oh, so you use it. You're part of the 30%.
I use it for preparing slides.
Yeah.
So there's a lot of good images you can capture.
Yeah. If you love the product and you like the stock, right now it's kind of overvalued. I wouldn't buy it right now, but I think when everything deflates, there's going to be just have your cash ready.
Yeah.
Save up cash right now. Save up cash. Invest in value and just wait a little bit, because when the time comes, that's going to be the biggest trade that you could make. It's going to happen, but we just got to be patient, and enjoy the good times. Right?
Kay,
Yeah.
Kay, I told you I had to leave at 11:30, and I'm just going to leave you with the two things I left in chat. There's a link to that flowingdata.com site where they do the startup business cycle. And then I've got a Twilio theory in chat. I think they're suffering from Ring Central, Google's Google Voice releasing an API just not too long ago for the big API.
To answer your Twilio thesis, I think it's more macro, because that Google API technical issue, the markets have previously priced it out. Like they don't even care about technical issues.
I think it's both. Absolutely.
Oh yeah. Okay. Yeah. Well, in that case. The recent one I feel like is really macro. The markets have been flooded with so much money that it's pumped up things that shouldn't be that high. So for wise investors, I say wait and let it deflate. And again, the biggest trade is yet to come. Well, for a short seller, they would say the biggest trade is right now, man. And then we have Beyond Meat. This one I'm super bearish on. I like the food. But I don't want to eat too much, right? It's like emerging food. I don't want to be the beta tester or whatever, right? Yeah, they did the testing, right, with the people with the scientists with the suits and all that, but I'm talking about data over a period of time. So Beyond, I think, is a great short trade. If you want to do it now, 160 as your resistance, not bad. But I think this one will go really low. I think this one will go to $40, to $50. Yeah. So anyways, we finished that one segment, okay? We looked at a bunch of stocks, but to reminder, what segment was that? I was talking about that post-IPO performances have been very poor. And I showed you some of the hottest names in the market that came out recently. They're all pointing down. Okay, so what other angles in this world economy that we could maybe determine if there's any further indication of a dying bull market? Global markets have been choppy for 2 years. Okay, this is Axel Merck's recent technical analysis. He sees support right here at the prior breakout. Also the 50-day moving average. So we're going to be light on the market analysis today. So 2 years. So what does that look like? Since 2018 till now, it's still relatively a sideways move. To me, I don't really think we've gone to new highs. And I think the month of the ending month of September on Monday, as well as October moving onto Tuesday, it's going to be pretty interesting. So I'm looking at long volatility. I'm looking at long precious metals. I think precious metals right now are going to pull back a little bit, which is okay. That gives opportunity for people to buy. But seeing a 6-year high in the gold market is indication of initial trend change. So I think the gold market's just starting, and save up that cash. And I'm not a recommendation. This is all educational purposes only. Always hedge. Anyways, S&P 500 sideways since 2018, practically. Nasdaq since 2018. Again, it's weekly charts. Since 2018, very choppy, very difficult environment. A little bit higher, but let's see how the central banks engineered this higher move. Dow Jones Industrial Average. This one's been the most choppy. Look at this. Relatively sideways, stuck in this box, I would say, for 2 years. Japan. How has Japan's stock market been? Well, very choppy for 2 years as well. I think if you communicate to someone across the world in Japan, they'd be like, in their language, I feel you, bro. Right?
Right.
Yeah, they feel the same. Looking at Europe, oh, I don't have my DAX on here, but looking at Europe, same thing. And since I don't have the DAX, let me pull up the DAX. DAX is Germany. We look at the major pools of the world, right? Not metals, indices, and then looking at the DAX for the last 2 years. So right here, DAX for the last 2 years, and we know that they have the lowest PMIs, right? So they actually have a confirmed recession. Whoa. They have a confirmed recession, right? With a below whatever PMI, below 50 PMI. This is their last 2 years' performance. So, yeah, not much growth. So that's another thing to look at to answer the question, are we still in the bull market? We've been in a sideways market for 2 years. Earnings slowing down as of late, and I have an updated chart, 9/25/2019 by Axel Merck again. Similar to the LEI index that I showed you guys earlier, which is the economic numbers, this is what the earnings look like. The black line is the S&P 500, right? And then the gray line is the one that we want to look at. So let's back test this and look at the gray lines in 2001 as well as 2008. And then this blue area is actually
Always stay in the right frame. Frame में रुकना है.
I know who that was, so I'm not gonna say anything. I don't know what he said, but okay. So the blue line right here, those are recession points, right? And then the gray line is the earnings backdrop. Is it? Yes, the 12-month earnings per share. So as you can see, our earnings has been going sideways. In 2015, earnings went down a little bit, but this is the updated earnings right here. Life of a money manager, tracking the next little centimeter of a line. Yeah. So what? Okay. Little summary. Earnings is just going sideways, for now, from an S&P 500. Another thing that I'm looking at, and we talked about this already, is corporate debt, expenses, and buybacks are at record levels. Now, you already saw this, right? But I have some updated charts that I'm going to add on top of it. And then for the people who are new, this is another angle to look at. So we look at the stock market, we look at the IPOs that were doing bad, we look at the private companies that didn't IPO yet that did really bad, we acknowledge the geographic or geopolitical, the demographic, aging, the economic numbers are kind of slowing down. Now we're going to look at corporations and what are they doing? Because corporations are like human beings too. They also have balance sheets and income statements. Well, they have record levels of buybacks is what we acknowledge so far. Meaning they bought back a lot of their shares that surpassed the level of 2007, 2008, right? So this is where we are today. So they hold significant amount of their own shares. It's like me saying, okay, I'm going to issue K shares, and we're going to do 100K shares into this club. I own 60, 70%, okay, and you guys own 30%. And I'm going to go to the bank, and I'm going to say, bank, I want to buy back my own shares. Give me free money. And they say, okay, cheap interest rates, you get it. All right, now I got money, and I come back to you guys. I want to buy up another 10% from you guys. I have to buy you out at market price, and you guys will have to value my valuation. So I buy you out, and if you guys, there's less shares outstanding. If the stock starts tanking, it's going to hurt my valuation because I'm buying ever higher. So that's just something that you want to think of about these corporations. They're just like you. They buy back shares as well.
It inflates earning per share. So the question is, in previous years, how much of it has contributed to earning per share increase?
Yeah, and I know you work at Intel, and like Intel, man, they could go buy some massive amount of shares. I don't know who the guy. I could probably look him up, or him or her. Whoever's buying ASML and what's the other one? There's another startup. It's like Intel has some massive investment positions. It's insane. Actually, I could probably look up their portfolio right now. Let's see how much information I have. Now, this is actually very good information because you could kind of figure out how you want to play. No, we're not looking at Intel stock. We're looking at, if you buy Intel stock, we're looking at Intel's portfolio. Right? They're super bullish on Cloudera at 26 million shares. Isn't that interesting? They're the biggest holder, if I recall. Shares outstanding, 9%. So So it'd be funny if like you're all smiling like, oh, I'm the guy who bought Cloudera at Intel. I'm just kidding.
Yeah, 1% of that is me.
Oh man. But yeah, they're bullish on Elastic and then these other companies as well. I love it. I love just digging deep into these corporate treasures, you know, and seeing what they're buying. So it just reinforces my investment position to Cloudera, which is a relatively undervalued security in this very overvalued market. Again, going back to the bands, you know, the 3 bands that I drew, Cloudera to me, if this is the average price, I'm buying Cloudera over here, while CrowdStrike and MongoDB and all that, or Uber over here. So if everyone's going to go back to the average, then I think this will go back to the average, which is up. And then plus more, better. Anyways, that's Cloudera. Okay. Carl Icahn, Intel, Greylock. Those are just solid participants in Cloudera. Yeah, so that's buybacks. Recognize that S&P 500 buybacks are at record levels. They're buying back their own shares. That actually explains why we haven't dropped, to be honest. If S&P 500, and we're tracking S&P 500, but I'm seeing like all these startup or post-IPO startups dropping like flies, this explains a lot. They're buying back shares to hold themselves up. Now, on top of that, dividends are coming up as well, right? Dividend expenses. So just something to know. Because you know, as a bigger company, you issue dividends. This new chart right here, this is from the Federal Reserves themselves. Let me try to recall, what was I saying? Business and household sector credit to, what was I saying in this chart? Okay, right. This is the leverage of businesses. So the red line is business leverage, and then the black line is household leverage. So as you can see today, the consumer is not as leveraged compared to businesses. Remember what I said? The Achilles heel of today is corporations. The bubble's in corporations. The bubble's not in consumer, not so much, I mean, consumer real estate versus corporate real estate, right? If corporations are buying out these pieces of land, maybe, but yeah, that's where the central bank sees the issue. They see.
So if the earnings are low and the debts are high, the risk is higher.
Say again. If the earnings are low and the debt's higher, the risk is higher.
Yeah.
Yeah. But debt owed by these businesses is historically high, and risky debt issuance has picked up recently.
And also, right, sort of share buyback, right? They've been leveraging up.
Yeah. Further leverage. Yeah. So. I mean, how would you play if you were Intel? Well, I can't ask you, but how would you play if you used to work at Intel? How would you guys play?
Move to AMD.
Yeah, yeah, like okay, move to AMD. I guess that's the play. Anyways, going back to this, so that's corporate leverage right there. So now we looked at another angle to answer the question: are we still in a bull market? Another one: consumer leverage is decently high. Now we're going to look at the consumer. We looked at the corporations. Now we're going to look at the consumers. In the consumers, there's different tiers. There's the prime consumer, who has like, you know, top line credit scores, and then near prime and then subprime consumers. Right now today, it's this is 2008, right? Our prime consumers actually are higher than 2008. So interesting chart. I found this very fascinating. It's not so much the subprime over here. So what is that saying? This is loan balances, right? Net loan balances of the prime. That means, statistically speaking, from this chart analysis, everyone in here is pretty loaded with debt.
It's not mortgages, right?
Just yeah, loans in general, just like aggregated. Yeah. So everyone in here, I'd say, is probably, now this could be most likely from mortgages, right?
Most of it is.
Yeah, most of it. Typical profile, mortgages. Would you say student? No. But yeah, interesting chart, guys. Another one I have. So now if we dive deeper into the specifics, right? That was the aggregate. Now if we look at specific consumer bubbles, this is where the central banks are seeing it. Student loans, right? And then the black one is auto loans, and then credit cards. It's not a credit card bubble. And now this makes a lot of sense to me, because I know a startup so I know this AI startup, right? And the CEO is, he recently got 41 million from Goldman Sachs. And for the longest time, I've been trying to figure out, like, what is your market opportunity here, man? Like Like you're a CEO of AI company and you're selling credit cards, but AI, so your software. So I finally realized what they do. So there's this company in Palo Alto. They're basically building out a AI software platform for credit cards as a service. CAS, right?
What's that mean?
Credit cards as a service. So they're actually building a marketplace where credit cards are just credit cards. It's just money, right? So it's really what they are is a software company that's AI driven that will intelligently find the younger portion of the economy to give them credit cards to. So right now, from a macro level, I can see why. It's what?
Predatory.
Yeah, it's always predatory. I mean, okay, the investment game, if you're in it long enough, you kind of see everything's predatory. Life is, even though we decided, we walked away from the primitive era of not killing each other, we do it today through trading with each other, literally. It's scary stuff. So in the world of credit cards today, there's a portion which is like, I don't know, what's the soonest you can get? 18, let's just say 18 to 25. Right? Apparently, this is the millennial market, and it's a really big market that most institutions have no traction in. So now I see it because majority that have credit cards are beyond here, like 30 and up, let's say. And so looking at this chart right here, if I was a institution, or if I was that startup, now this is coming up with startup ideas and why now I'm seeing this market opportunity. Well, it looks like the majority of consumer loans out there don't have credit cards. And if we analyze the structure of the credit cards that are existing out there, majority of the age is 30 and up. So how can we come up with leveraging technology to get the 18 to 25-year-olds to lever up as a credit card company? Well, we know the credit card companies want that, but we're not getting into the credit card lending business. We're AI software, so our valuation is going to be higher. What we're going to do is create an AI software company, call it Credit Cards as a Service, talk to on the B2B side to the credit card company and say, hey, we could get you exposure, traction to the 18-year-olds to 25-year-olds, right? And then over here, we're going to go and market to universities, which is what they do. So now they're planting themselves at Stanford, UCLA, UCSB, everywhere. And they're just marketing there. And they're capitalizing on this opportunity right here to bring this little line right here up. Because it's the lowest, right? So what does that tell you? That tells you that in a very tight economy, there's not going to be opportunities in student debt, man. They're already like drowning in that. Right? What's that joke from that one guy where it's like, imagine yourself in a river, you put your hands up and someone gives you a baby. You're drowning in a river and you have to make it across the river. I forgot that joke.
Yeah, so people here have an Apple account, Apple Card. How fascinating. Isn't that incredible?
Now,
all this hype about this horrible card, quite frankly, and not one person in this room who's the total target for that card has one.
Yeah.
How many people are going to get it? None. Isn't that amazing? All this hype about the visual bullshit on the phone. When I talk to in this room has the card.
It's funny. Now that you mentioned that, talked to
one more question. How many have Apple Pay?
Why you mean to use it to pay with their
Now let's connect some dots here. Apple Pay is mobile, digital. What generation is most adaptive to mobile? Generation Z. Z and millennials. Right? Because when we talk about that card, right? Maybe this older profile in here doesn't talk about it, but I hear people in the 25, 24 range actually talk about it.
You have to be, this is really what drives me crazy. Apple announces this Apple Card.
Yeah.
They take a nice paintbrush and make the thing look real pretty, and I can look at my spending, and who the fuck cares?
Yeah, it's the same service. It's the same service.
But if you can use Apple Pay, if you have any brains, you get a Chase card and a Citibank card, which give you 3 times the rebate than what the Apple Card does. And when you walk up to the register, you pick up the card that you want. It's for idiots. And not one person in this room who Apple's saying they've solved the world of the Apple Card is even interested in getting it. Isn't that amazing?
Well, one explanation could be financial, meaning everyone in here already has credit card debt. I'm not trying to be mean. I'm just saying maybe they already have credit card debt.
But the target audience,
the target profile is the younger people,
and not one person has it.
Yeah.
So it's been just there's a barrier to entry, right? So why would I go for a new card when I have three other cards?
See, so he's already stacked up with cards. Come on.
The Apple card's not as good.
I predict that card will fold. They will get rid of it.
Well,
it's for a different age group, I believe. It's for the Gen Z, as he said.
But
I think Bernard's right. It's not that good.
But you guys see what's going on here, right? let's say I'm a market strategist and I'm trying to do the TAM analysis, total addressable market analysis, and I'm looking at this chart. Well, it looks like student loans are already capped, auto loans are capped, and if the economy's not going to crash, time just keeps moving forward. So we just have to keep capitalizing because time's not going to stop. So I'm looking at this chart and it tells me, well, the best opportunities in credit cards. Now I'll go into that market and start segmenting. Well, it looks like the 30-year-olds are all stacked out with cards. It looks like I got to figure out a way with technology to capitalize on this younger crowd. So now I deeply understand like this Palo Alto. It's whenever there's a Palo Alto startup, not Palo Alto Networks, but Palo Alto, you just got to pay attention to it because, you know, fast money, sophisticated money tends to be in the same area.
It was disappointing in a way that Apple, I thought, was going to be a competitor for Visa and MasterCard. I can't buy Visa and MasterCard. I like those stocks because it's very hard to. I thought Apple is going to be one of those guys on those pillars, and I thought of investing in that because of that reason. But
you know, I don't think it's because now I know technology, right? Data and software. Maybe it's not a pure credit card play. It's a data play.
it's a data play.
Because look, if money investment opportunities are all capped out in the next, and they're not going to let the economy crash, then us as an entity, we have to keep looking for opportunity. So we have to keep looking for opportunities. Like, well, the money stuff's not working anymore. It's the data.
Yeah,
It's got to be the
and
data,
also
man.
Apple wants to pivot itself to service, and it gives you a correct picture of your financial sense, where do you spend money.
Yeah.
Exactly. Have their transactions.
Yeah.
It's the card to get your data, you're spending the money.
Oh, well,
I don't believe it. Show me one 18-year-old, like my son in college, or 21-year college, who pulls up a graph of how much they spend every month.
Yeah.
And how much they shouldn't be going to restaurants. I don't believe it for a minute.
okay. All right. Next. Next investment club field trip, we'll all buy a share of Apple, go to the annual shareholders call, and we'll ask the question:
Right.
what's the growth story of your credit card?
Right.
We'll get our answer, right? Well, auto loans. Okay, so if you segment out auto loans, the prime is capped out. So the best of our borrowers have too many cars, it's telling me. Right? Because blue is near prime, and then red is subprime. This is telling me, like, man, someone, like, what happened to the prime over here?
This isn't a percentage of people, right? If you have a percentage of people, then it might be different. It
I don't
doesn't mean
know.
dollar.
No, it's not the percentage.
It's basically dollars.
Yeah, but dollars could be converted into like number of vehicles.
Right.
So this is just segmenting it by the best borrowers actually have the most amount of dollars invested
That's true, right?
into a depreciating asset.
The best people will buy new cars.
Yeah,
Those who don't have will buy second-hand old cars.
yeah,
Those will be near prime, subprime.
yeah.
You won't have a subprime guy buying a new car.
Yeah, so let's say if I was a small business owner, right, and I wanted to short this, I'm gonna be investing into like car repo businesses. No, I'm just kidding. In the next recession, let's say, that's gonna be hot business. I mean, from a micro level, if you know the auto market really well, and you know that these prime could become near prime or subprime in the next pullback, right? You probably get some cheap vehicles. You can short sell some cars. Right? There's a deal and trade and everything. You just gotta think about it. Like what's the difference between what I said about right here, right? It's too high, I want to short it down, versus the credit card over here, it's too low, I want to go long, right? So maybe a great model would be like an AI startup that does artificial intelligence sourcing for overvalued cars. Carvana, I don't know, something like that. Carvana was a recent IPO. Yeah. I love this type of thinking. But anyways, we're going to move on to the next segment because it's going to be. You guys okay? It's already like 2 hours. We're going to be 12:30 today, maybe if that's okay with you guys. Anyone's welcome to get up, get water, or even leave anytime. Okay? I never force anyone to stay.
Fantastic.
Huh?
Kai, I got permission. You got me out of the air, and I was supposed to run at 11:30. I got permission to stay, and now I'm all by myself listening to you. Thank you so much.
Hey, no, you're welcome, man. Kind of old to get permission, but all right. Okay.
Yeah, I posted another link you might enjoy on chat too, relative to something you mentioned earlier.
Sure. Fred Lewis. So let's see. What do we have right here? I think I might. Well, net domestic investment, corporate profits. Interesting. So this is telling me net domestic investment. So money that we're investing in our corporate profits after tax. You want to explain this chart to me, real quick, if you can?
So like the red line that's really boomed. The red line that's boomed is corporate profits divided by GDP, And the blue line is business investment, how much we're reinvesting in businesses in the economy.
Okay, I see.
So I think it's still a bullish outlook.
Okay, interesting. Yeah, good share, man. Yeah, I want to take a look at this chart later. But let's, well, a little bit halfway. Well, not really, it's more than halfway. Next part I want to talk about to answer, are we still in a bull market, guys? Well, this part's pretty interesting. Repo markets experienced liquidity issues. This could be signaling something further weakness in the structure. So for those of you who don't know what the repo is, and it gives you really great insight into how the economy works. What happened is, this is like the rate. So you know how there's big money that moves, right? This is where you kind of have to understand fractional reserve banking, where if you go and try and steal money from a bank, it's a bit of a moronic move because the money flows constantly. Like the real gangsters that steal money are the ones that start a business, I feel. Because money's always in motion, right? But anyways, this is the rate that spiked recently and went on the news. So this is the rate that the biggest players ever that are trading with each other we're betting, we're saying, all right, if you need money for tomorrow, let's say, I don't know, whatever $1 trillion, I'm going to charge you 6%. 6% was really high, 8% was really high. So the Fed actually had to come in and lower this. Because if they start trading at this level, interest rates will actually go up. Right, so that was the fear right there. Because now what does this tell you? This was a situation where interest rates went up, not because the Feds made it go up. It's because of it's the system's a bunch of pipes, right? The pipes are getting clogged. So it got so clogged that the participants started charging each other 6%, and they came in to nerf it down. But when you come in and you buy it down, it hurts the taxpayers, which is us. Yeah.
Liquidity issues, right?
Yeah, yeah. I mean, it's like, we hurt the taxpayers to save the system, man. Okay, all right, that's good. That's a good rebuttal. Well, that's really what they did. So, I think it was a really important event because it really revealed the fast discretion of the Feds, meaning like how willing they are to hold up this market. So moving forward, what does that tell me? Well, I think the participants in the markets are selling off the growth momentum, dreamy stuff, but I'm also seeing the Feds aggressively holding up the markets. So that's why I'm saying let's get out of growth stocks and focus on value, because the market's going to hold up, which is crazy. I mean, they're going to try and hold it up. But I'm seeing companies like Salesforce taking a hit. So the repo thing was pretty important. So I think the best way, I have it in my head, and if I could draw it to you guys, what this repo stuff means. And I'll probably only draw this once. So this is kind of how I view it. So let's say this is the economy, right? We have the economy right here. The repo is basically like this. This is the repo right here. You guys understand transaction size? Like at the lowest level of the economy, you would have like a transaction of like $1, right? And then you go up and you have bigger transactions like enterprise. But the repo is sort of like it's a mechanism to keep money moving around. And we're talking about trillions of dollars that are being traded between dealers, right? There are dealers, and then there's our sovereigns. Those are the people that are playing up there. Authorized dealers, and then investors as well. Big, sophisticated hedge fund investors are playing this. So if they're playing at 2%, right, it went up to 6%, that's what they're trading at the top. And whatever these guys do at the top will fundamentally hurt the economy all the way down. You see how substantial that is? Right? And so the Fed knew that if they were trading at 6%, because what it is like banks trading with banks. And we get our money from banks for mortgages. And corporations get their money from banks for corporate loans, right? So if the big players are playing with sensitive interest rates, well, if it spikes up, it's going to kick back down to the rest of the economy. You're going to feel it down to your cup of Jamba Juice right here, maybe, or your job. No, I'm kidding. So that's kind of how I interpret the repo event. This is the closest source of the piping of the system. It's getting clogged, and they came in to devalue it at our taxes.
So does that mean interest rate will be higher as you go
They lowered it, right, to not let it go higher because it's like, oh, if the sophisticated players are playing at 6%, right, they're trading at 6%. Why am I lending as a bank? Why am I giving out mortgages at 3-4%?
Right.
I should be doing 7,
Right.
right? So it's good for banks.
So there's an underlying risk that the interest rate could go up.
Yeah, yeah. Yeah, I mean, I just wish I could explain better about how the money system works. I think the best thing for you guys to know is fractional reserve banking. Understand that money is really multiplied, and because of this nature, yeah, I'll show it right now. Because of this nature of money being multiplied, it's very critical for the money to keep flowing, and that's what I feel central bankers are paying attention to. So let's review this once more. I reviewed this a while back. But let's say this is one person, right? This one person has $1,000. They put $1,000 into here. Is it better if I explain it the other way? That 1,000 will be lended out, right? And then they will hold back $100 to this person, and that person will spend it on this person, right? Which is $900. That 1,000. So this one's holding 100 in here. This person will take that 900, deposit into another bank, right? And the bank will do the same thing. Hold 10%. Lend out the other part to this person, and then this person will spend it on that person, and then that person will put it back into the bank. And all the time you keep doing that to the point where you have 90 right here, you have 80 right here, right? And you add these up, right? 100, 190, 180, and then you have like almost like $300. And that's how money's being printed. So imagine we're doing that at 3%.
I think it's more than that.
Less than that.
If you deposit 1,000, I believe the bank can lend 10 to 1.
Which is what they're doing. They're doing 9 to 1.
No, but
So if there is a rate,
1,000 deposited, right? It's not.
if the reserve rate were to drop, then the multiplier will be bigger.
No, what you're saying is that they will print 9,000 more dollars.
That's right.
That's not true.
Yeah.
That's not true. Though.
Yeah, that is right.
Damn, I was gonna show you this this classic picture, but I'll have to do it another time. You know the whole FDIC insurance thing, where they say they guarantee $250,000 if you have $250,000 in the bank. That's actually a false reality, because the insurance fund that guarantees that. There's a really beautiful picture. Okay, Demono Graphics, FDIC insurance. Let me see if I can find it. I do apologize. It's my favorite picture of all time, but I just can't find it. I just remember the website was like the monographics or demo. No, let's see, visual. Right here. Okay, all right. Let's see, the illusions of the insured bank accounts. Okay, this is my favorite picture of all time right here. Okay, all right. So I guess starting from the top right here, what you know what $100 looks like. Right? And then below you got, this is what $10,000 looks like, and then you got $1 million. And you keep going down, $100 million, you can sit on it like a couch. And then this is what, what $100 million could provide, about 2,000 jobs, assuming 50K a year. This is what $1 billion look like. And this is what the human is chasing, stacks of sofas. And then the FDI insurance fund, or building in San Francisco, is this big, right? And the insurance fund is $25 billion. Okay, they guarantee they're. All right, we'll go down. These are different buildings: Bank of America, J.P. Morgan Chase, Goldman Sachs, right? And this is the FDIC San Francisco, right? And they say that we guarantee you $250,000. So their insurance fund is $25 billion, and they have to guarantee from fractional reserve banking. There's 1.1 physical money in circulation. Like actual money in circulation. But because of fractional reserve banking, it created 9 billion. 9.3 trillion. You see what I mean? So, and then that fund is going to guarantee, it's only about 25 billion. So, in all reality, if your money's not really safe in the bank, because it can't even guarantee the circulation, right?
Slightly different.
Sure, what you got?
So here's the thing. So it is 250 no matter how much you put in. Right?
Maximum.
Maximum.
It is up to.
Up to 200. So if you look at the people that put in, right, we are 100 trillion or 1,000 billion or whatever, 1.1 trillion. Probably 10% of people own 90% of that.
Yeah, so it forces them like, hey, we're not gonna, you guys are already, you already made it. You're not gonna guarantee.
Most you'll get is 250K.
Yeah, so that's probably true, right? Another way to think about it is, I mean, they flood it. They flood the game with more money. Let's say they flood the game with more money. Now everyone has 250K, and they're like, oh, you know, what are we gonna do? It's gonna force everyone to invest. Now remember, sovereigns don't operate on money. They don't care about money. They make money, right? What they want is your human effort. And that's something I value more than ever these days, because the effort, the chase for a dream is really like meaningful. But that's what they want. They want economic growth. They want, they want this. It's a game. It's just keep playing. I mean, that's a sad reality if you really want to know the answer. So you got to create meaning yourself in life. Okay, we won't go down that path. But now you know the whole 250K and the derivative exposure and all that.
But it never happened in the past. That big spike never happened in this past, right? We have never seen that big.
Yeah. So
just like overnight, just from
yeah.
right?
So this is really a liquidity issue that could cause the dollar to spike. That means the dollar could rally like crazy, right? Now famous investor Jim Rogers, right? He's extremely bullish on gold, but he's also bullish on the dollar. And so I'm like, oh man, this is so he honestly believes that when fear kicks in around the world, they're gonna run to the dollar. But because the situation is so like crazy that gold's gonna go up as well. That's his thesis. We won't read this primary dealers. We're gonna skip those two. It's just explanation of like who the primary dealers are. I mean, do you guys want to know the whole? This a little bit more insight into what repo repurchase agreements are. Okay, all right, we'll go to the next one. Central bank. So another question as to are we still in the bull market? Central bank intervention and executing fast discretion. So these are not new charts right here, but this is the effective funds rate, right? You notice in 2008, it flatlined, then went down, flat, and then went down. So they're lowering interest rates right now. Because historically it just goes flat and then up, flat and then up, flat and then down. So this is the first time that they're lowering interest rates in a while. Why? Market's still at all-time highs, but been going sideways for 2 years. So that's something to think about. To ask the question: are we still in a bull market? And then with the repurchase repo event, it was so serious that they're trading off our hard-earned money, right? Because we pay them tax dollars to go save the system. So this is their balance sheet right here, right? They're buying treasuries. If they're buying treasuries, they're giving money away. If they're giving money away, what's the cost to save the system? But it's at the cost of our own, our tax dollars. So I wouldn't be surprised if taxes go up. Not at all. Which is crazy. Yeah, that's insane.
So invest in 401k tax.
But I mean, okay, we all complain about higher taxes, right? But realistically, if we were all paying, let's say, not 50% tax, and everyone was just paying 5% tax, well, home prices would be like $3 million, man. Right? It's no different. I think it's okay. As long as it's only okay as long as we're all equally taxed. Now it's those CPAs that know tax really well are not paying their fair share.
Will this lead to stagflation like the 70s?
Will we see it? You say?
Will this lead to stagflation?
Let's see. Remind me of the definition of stagflation, where you have
stagnation of growth.
Yeah.
High inflation.
Yep.
High interest rate,
Yeah.
recession.
Yeah. That's definitely a possibility. We should get into a discussion of stagflation, inflation, deflation, reinflation. We gotta talk about that one day. It's absolutely interesting stuff. I'm not sure. We're at unprecedented times, and I'm just a guy who teaches finance. I don't know enough.
Hey Kai, to answer the question, the term is secular stagnation for the tax haven based problems with growth, and then the energy crisis was the one that was stagflation.
Okay. So that's central. So I'm going to continue here because I want to be respectful of everyone's time. I do apologize. Central bank intervention in executing fast discretion. Are we still in a bull market? They're so quick to adjust. Why? right? They're so quick to reveal their hand when everyone's been watching the FOMC meeting and wondering like, what are they gonna do with interest rates? But they were so quick to print money. Why? So that's the question to ask. Are we still in the bull market? Global sovereign debt at record levels. So this is a new one right here, because normally before I would show you our U.S. national debt, right? It probably doesn't even matter now anymore if you believe in monetary MMT. 22 trillion in debt, right? But I never knew about how high it was historically. So this is the chart right here. 22 record levels.
Yeah.
But I don't know. I mean, this can only continue to not matter as long as the rest of the world agrees with it, right? It's like, oh, the dollar is like the weapon. They weaponize the dollar for the world. And we're going to let them keep having that or not. As a country, as China, I wouldn't want that. So they're fighting to, make this not true anymore. But if they do, then they're going to make our debt very unsustainable. I mean, that's the reality. Because we're only getting more debt because we have a monopoly on the game. But they're trying to destroy our monopoly. That's my take on that.
Monopoly like oil reserves or as a reserve currency or what?
I'm sorry, what'd you say initially?
When you say monopoly, what are you referring to?
They have a monopoly in terms of everyone's operating on the dollar as the platform.
Because of the reserve.
Yeah, as a reserve status. They don't want the dollar. Anyone that has it seems this way, anyone that has the reserve currency status in the world has a lot of economic power. Because, again, sovereigns don't care about money. They care about what humans do with the resources, right? So if the reserve currency is in the dollar, then they can manipulate that. Then they care about what the humans decide to do with it, or the human capital. Interesting look at the world, I feel. And then the debt across the board right here. U.S. 22 trillion, China, I didn't know, 9.6 trillion, Japan 12 trillion, Germany 2 trillion. Is it 2 trillion? Yeah. 3 trillion, 2 trillion, 3 trillion, 2 trillion. So you notice how most of them are not really in the double digit besides almost China and Japan. But U.S. is 22 trillion. This kind of reinforces the whole concept of reserve currency, right? The person with the most debt is the reserve currency. They are the monopoly in the game in the current time frame until the game breaks down. Yeah, interesting stuff. Now, on top of the debt, right, you saw that it's at record levels right here. This is the total public debt. Public debt meaning it's all of our business, like the library. The library should be all of our business because we kind of pay taxes for it.
Well, I think you can also look at like the growth of the GDP.
Sure.
Because like if the debt is not growing as fast as GDP, then that would be a problem.
Yeah, I'm just looking at the aggregate net debt amount, right? I'm not looking at that, but you're right. That's a great comparable. I think that's one of Warren Buffett's favorite indicators. So interest payments, record levels for the government as well. Right? We lend to ourselves and we pay ourselves even more. Okay, moving on to the next segment, the FANGs. I'm going to move pretty quick because of time. The FANGs, Facebook, head and shoulders right here. Looking pretty weak, testing the 200-day moving average. Nothing much else to say, but the big players are showing weakness. Amazon, below the 200-day moving average. It was there last time, but went right back up. Could be a trading opportunity, but again, this is show of weakness, in my opinion. Slight weakness, not as bad. There's more strength in Facebook, but also showing some weakness. Apple showing strength is what I'm seeing. What did it say right here? Okay. And then Netflix. Netflix is one of the beloved FANGs. This one's really down and out. I think SK wanted to buy this opportunity right here. Right? Now, would you buy it now, or would you?
I mean, the CEO himself sold the stock.
Yeah,
like,
yeah.
Insider trading.
Yeah. So why is that?
Because of this competition from Apple and Disney coming up, right?
Yeah. Stack that with uncertainty around global macro, and then the high stock price.
And these are pretty credible players.
Yeah. And then consumers who are leveraged out on prime loans, or prime consumers are leveraged out, so they can't buy more stocks. Or corporations are at max buybacks, they can't buy more stocks maybe.
And basically it was a monopoly till Amazon Prime, Apple, and Disney.
Yeah. Okay, Google. We're going to end real quick. Google, showing strength, I say, maintaining this trend line. I like Google more than Netflix. I do too. Next segment. Why are we still in a bull market? Gold is at 6-year highs. This is probably my forecast for where prices want to go, maybe a decline then higher. This was a great chart I wanted to show today. I wanted to speak more to it, but maybe not enough time. but it just goes to show you that it's from the safest asset, which is gold, to the most riskiest. Okay. At the top is obviously derivatives, and you guys know I like to play options, so those are derivatives. And then non-monetary commodities, so that would be that'd be like oil and stuff, and then real estate up here, right? And then corporate and municipal bonds, so fixed income, and then government bonds because it's the government, right? The game maker, and then bank money, so like repos, and then base money, and then gold. Interesting, huh? This was actually from the In Gold We Trust report. And I can't quite remember, but I got to circle back maybe next week on this. But the famous investor who did really well over the years, who outperformed, he was featured in that, and he was talking about this concept of like the reverse pyramid, basically saying that people think that currencies is the most safest form of an asset, but in reality, when the government starts devaluing the currency, it's really actually gold. So he said that in certain times, gold will be the true safe haven, and yeah, I mean, that's why I like it. Man's 6,000-year obsession, protection from the sovereign, the default currency when the monopoly game is over, right?
So gold stocks will be considered the same as gold or not?
It'd be a derivative of that, right? Because they mine gold, which is the precious metal or the true agreed upon currency, but it's been diluted. It's been diluted because it's like every generation, right? I tell you guys, every 100 years is a different set of people in this world. So every 100 years, but the government kind of remains there. They'll say, hey, you got to follow this currency. And so the whole memory of like, oh, gold is superior kind of decays with the generation exiting. So it's people who really know their history kind of see this. Very fascinating stuff. Yeah. Because gold is like 6,000 years, but what, USA is what, 200 years? Anyone, the exact number? Okay, I'm going to move a little bit quicker. I'm just going to show some quick charts right here. So now that we looked at the post-IPOs, the pre-IPOs, some other stocks are like the top cloud high growth stocks that exist out there today. So Salesforce, look at this chop. For a longest time, Salesforce has just been going sideways. If I was an investor or trader, if I was a trader, more active trader, then this would be nice. But investment-wise, this is tough, really, really tough. Same thing with Workday. Workday now breaking down below the 200-day moving average. Really tried to fight the 200-day moving average, as you can see right here, but broke down further. Again, Workday and Salesforce are world-class entities. So if they don't perform, this is very significant indication, in my opinion. ServiceNow, another big entity, 50 billion if I recall in market cap, nearing its 200-day moving average. Also in a midterm downtrend in the last few months. Not looking too good. Palo Alto Networks, another gold standard security out there. That fund money is just not pushing this one up anymore. Cyber, profitable software company that I like. If it goes lower, I'm really going to look at this one. I'm actually really happy that this is going lower. I like this one a lot, but just not right now because the trend is very confirming downtrend. Twilio, this is like the venture capital favorite. So what I did in Guru Focus, I haven't showed you guys yet, but Guru Focus is, okay, for those of you who don't know, it's the software that I pay for to get all the money managers in the market and see their positions, right? So I've collected all the software hedge funds out there that bet on tech, and the hottest, and then I've aggregated all those fund managers, and the most popular one out of all those fund managers is Twilio. Yeah, why don't I just show you guys instead of just explain it? Let's see, show you guys real quick. So gurus, list of gurus, and we'll go to, where's my list? SaaS gurus. So I created a SaaS of 16 serious hedge funds that bet the way I like to bet, and I wanted to see their aggregated portfolios and see where their, was it the consensus pick? I think it was this one. The consensus pick came out to be Twilio as soon as it loads. Or no, hot bargains, aggregated portfolios, hot stocks. Maybe it was hot stocks. Nope. Trends, guru bargains. If I can't show you today, I'm going to show you another day. Okay, for time's sake, another day. But Twilio came out to be the most popular one. So this going down, I have a lot of, I have my eyes on this one. MongoDB, same thing, breaking the 200-day moving average, looking very negative, I feel. Square, another one, high growth, but not doing too well. Paycom, another one, high growth, now kind of breaking down initially right here, breaking its 50-day moving average. Imagine if you just traded the 50-day moving average, and you respect that. this would be where you really confirm out. Arista Networks. Again, that one's a favorite, but they have lumpy sales, and this is what's, in the past 2 years, what they look like. It's a great company. It's another gold standard. They have a solid building, too. Splunk, same thing. Last 2 years, tough times. I usually like to play when it's like this. And then go into real estate prices locally real quick. Palo Alto, prices still going sideways. Market Action Index, slightly down, but still quite sideways. Mountain View, little spike up in the recent maybe day or two, but maybe just one transaction or a few. But overall, market action in the last month was about sideways. Cupertino, slightly down, 2.4 million average, sideways for the price. Yeah, I know.
4 million.
Oh, you're still back there. Yeah. we went all the way to the Cupertino, but you're still like registering the 4 million in Palo Alto. Sunnyvale, slightly up, 1.8 million. Market index is still down. Santa Clara, sideways, 1.3. Okay, and this is the assuming typical size, 3-bedroom, 2 baths. Market action is 50. Milpitas, 1 million. And again, everything's just kind of going sideways right now in the markets.
If you look at the inventory, it's so low though too.
For
like 250 houses in the whole Bay Area.
Yeah, like on the markets, right? Well, I mean, recently transacted. I mean, there are thousands. Housing price to rent ratio. So another, just price to rent. It wasn't as bad as 2008. So that's why at the beginning today I said like, it's not really a real estate bubble this time around, because if you look at 2007, 2008, this was the price to rent ratio, a lot higher. This is where we are today. So I don't perceive it, I mean, back then, yeah, 40% dip made sense. Today, I'm not a super expert at this. I rather we go to Mark Hansen, but I'm saying realistically, if everything hits the fan, 15 to 20, 10 to 20 to be safe.
You should write this to Mark Hansen.
Wait, what?
You should write this to Mark Hansen with this chart.
He'd be like, what took you so long? That guy's on top of his game. He's a Palo Alto mortgage lender, real estate investor, and flipper in that segment. He's not too far from us. I just don't know what he looks like. We'll find him. We'll find him somehow. Commercial real estate prices. So we looked at residential, right? Now some insight into commercial real estate prices. We're going to move a little bit quicker to end at 12:30 here. But the story's still the same. For commercial real estate prices, it's hitting 2008 highs. Okay, so the guy I met recently who wants to do this, I want to show this to him and just say, hey, you understand the market conditions, right? We're at the lowest of cap rates. Cap rates meaning if you buy 1 million, it pays you 6%, which is $60K a year. When historically in recession, we get a high of like 8%. So if we start getting national 8%, then you could get off market for like 11, 12%. That'd be pretty nice for commercial real estate. So yeah, I'm excited. Just hang in there. I think a lot of opportunities are ahead. Again, just to conclude this, prices in commercial real estate are at 2008 highs. Cap rates are actually below 2008 lows, meaning commercial real estate are not paying that much cash flow as they used to. Again, just tightening of the game. Global trade issues, which you already know, right? Trump threatening, hey, get out of China for the manufacturers. VIX has been pretty muted, not much volatility action. Global PMIs pointing down. So these are the major PMIs right here. So this is the updated one. Germany at 43. USA is already below 50. So these are, again, major economies that are pointing down in terms of underlying economics. SoftBank, malinvestments in substantial size can be damaging to the economy. If they lose, then it could potentially make us all lose. They could be the Bear Stearns of this cycle. Right? Bear Stearns doesn't exist anymore. They could be the Bear Stearns of this cycle. I realize now that every super cycle, you're going to have, just like they say there's a superhero, there's a legend in every generation. Well, there's a Bear Stearns in every cycle. So this one's starting to look like a Bear Stearns, right? So how big is this venture capital fund? Again, you guys saw this before. SoftBank's Vision Fund, $93 billion. Compared to everyone else, right? Top of the line venture capital funds are only like $1 billion, $5 billion. So this is a segment I want to play. These guys are disrupting the games, but their sustainability is in question right and their investments, right? So Uber, ARM, NVIDIA, WeWork, right? Just Alibaba's not in here. I think these are startup investments. Alibaba was already IPO'd, yeah. The other bets, I could send you this doc because I'm moving a little quick here. Who are the investors in their fund? Saudi money, about 45 billion. So 17 of it is in equity actually, and then the other part is in debt. Isn't that interesting? If I give you 45 billion and you're gonna go invest it, I want that 28 to be in debt, and then 17 billion in equity. That's the ratio. And then Apple, Qualcomm, Foxconn, they're invested as well, 5 billion, right? And then SoftBank themselves, about 28%, or yeah, in the game. Real quick, the collapse of WeWork was big, really big. It marked the end of the age of illusion. That's why I think it's the cherry on top. By age of illusion, I am talking about the fantastical, this time is different thinking that brought together the hubris build worlds of Silicon Valley and Wall Street. That by being bold and breaking things and moving fast, even 10-headed ladies in the sideshow could attract capital. And then I was going to talk about aging demographics, which we kind of know already. And then if you, again, this is refresher, the Google search term, 2008, if you look at it, right? 2008, the word recession was searched this many times. We looked at this last week, but I did the actual search myself and wanted to share it again. So this is today. So it seems like recession is in the air, right? But what actually will happen in the first spike is that it'll go down. It's actually the next spike that's probably gonna be more signaling. So right now it's like, ooh, like people kind of, okay, they get it, but I think with time they're gonna disregard it and markets go up a little bit more, which seems that way now, and then maybe a spike. And then again, to close it out, shift away from growth stocks into value stocks is what I'm seeing a lot of, and a shift away from intangibles to tangibles. In conclusion, how can we play this? Stay away from the vulnerable market segments, okay? Stay away from high growth in my opinion. Recently IPO stocks, as you saw, and overvalued SaaS securities. And what else? Beat down relative value SaaS is where I'm kind of hanging out right now. So like Cloudera, BlackBerry, educational purposes only. Learn to play volatility maybe moving forward because I think we're going to see a lot more. Gold continues to appear to be the safe haven to play right now. The environment has been too easy. So this is where I'm kind of planning out the strategy next, right? The environment has been too easy, so the finest minds and market participants will be uncovered in the next event.
So can you scroll up for just
sure.
I just hope people appreciate that perspective right there is what you would pay someone from Morgan Stanley to pay you.
Well, I used to work there.
No, but I mean, I just hope people understand that that perspective you're saying, I think is totally spot on, right?
Right.
And that I'm hoping people can actually leverage that kind of insight because I think it's spot on right that you'd be paying someone to tell you.
Yeah, this is powerful perspective. Like I know that for a fact. Like this could, a money manager managing 100 million could really use this.
Yeah.
This is where I really see opportunity. I know the game's tight. Maybe the investment club might get boring. I try to keep it entertaining, trying to find stocks, right? But it's getting tight for me too, guys. So this is like the best that we could do with what I know and what we know as a Silicon Valley investment group. So
for part two of this, okay, let's
part two,
assume,
huh?
let's
Damn.
assume that this is right, okay?
Yeah,
let's assume that those 7 sentences are right. So what do you do? Would be the thing. You got a bag of money. You got a bag of securities. How do you rebalance it? That's what I think maybe in the next meeting.
The next following meetings, I'm going to be looking more into oil and gas analysis, deeper analysis into gold miners. Right. It might get a lot more dry, but that's the analytical efforts that's needed to find these gold treasures.
Absolutely.
So guys, great session. 2 hours, 30 minutes. It was good. I hope I answered the question today. Are we still in a bull market? You guys saw many angles of the economy. And thank you guys. You guys don't have to clap that hard. Yeah. If you can shoot me a text, information is on the meetup, and I'll send it to you. I could go for one. I could go for a dosa right now, but. Shaw? Okay, just 1 second. Let me look at online real quick. I got a hard stop today.
Definitely the price will go down.
Happy Tulio. Okay, we got too many messages, guys.
All the Chinese.
You're welcome, everyone online. Sorry if I can't give you guys so much love compared to the room. It's a lot of people, but thanks for coming. Okay, all right. Yeah, you guys.